Good morning, friends. This is Soumya Narayanan, faculty for direct taxes. I am part of faculty team of KS Academy and I extend a hearty welcome to all of you on behalf of KS Academy to the fast track batch for CA final direct taxes. The batch commences on 1st August 2020 and it is expected to get completed by 31st August and it will be around 90 to 100 hours. This batch is primarily for students who are going to give examination in the month of November 2020. And the objective is to help them in consolidating and revising this vast subject within a short duration of 30 days. In this 90 to 100 hours, we intend to give coverage of all important topics for examination, and this is purely examination oriented. In this short duration, we will try to consolidate the entire syllabus so that it will boost our confidence for the examination. And I will be giving you a 350 pages material, course material, which is compatible with my classroom discussion. And this is going to be a very, very effective preparation tool and a revision kit. The day before examination, you can revise the entire syllabus with the help of this 350 page material and the classroom discussion also we will be using them. I will be projecting the contents of my material through the visualizer and I intend to cover these topics for the examination. Basic concepts, important issues and amendments in the topic salary, important issues and amendments in the topic income from house property, taxation of gifts, capital gains and business restructuring, mutual fund, business trust, taxation of non-resident Indian, taxation of foreign institutional investors, provisions of section 269 SS, 269 T, 269 ST and 269 SU. Then taxation of non-resident sportsmen, entertainer, sports association, new pension scheme, electoral trust, concept of mutuality, assessment of cooperative societies, taxation of dividend, assessment of political parties, assessment of trust, assessment of AOP or BOI, investment fund, securitization trust, amendments in chapter 6A, restriction on carry forward of losses, that is provisions of section 78 and 79, assessment procedure, post search assessment, issues in interest under 234 ABC, refund and interest under 244A, collection and recovery, appeals, liabilities in special cases, revisionary powers of commissioner, assessment of firm, settlement commission, double tax avoidance relief, advance ruling, transfer pricing, TDS, TCS, profit linked deductions and investment linked deductions, alternate minimum tax, general anti-avoidance rules, taxation of non-residents, profits and gains from business or profession, including the income computation and disclosure standards. Then MAT, penalty for misreporting or underreporting, equalization levy, miscellaneous amendments, all case laws covered in ICAI publication and other landmark judgments, and reason, circulars and notification. So that means almost the entire syllabus will be covered without quality compromise in an effective way in this 90 to 100 hours. Fine. Now, one more thing I want to tell you, a Telegram group, okay, will be created for the students who have enrolled for this batch. These students can post their queries, doubts in the Telegram group, and I will be responding to them. I will be giving clarification. Now, we will enter into the subject without wasting much time. First chapter, basic concepts. There we shall be learning the tax rates applicable for different categories of persons for the assessment year 2021. For those who are writing exam in the month of November 2020, the previous year is 1920, assessment year is 2021. So we will be discussing the tax rates applicable for assessment year 2021. There, first, let us discuss the tax rates applicable to individual. Individual can be categorized into three: super senior citizen, senior citizen, non-senior citizen. Who is super senior citizen? To call an individual as super senior citizen, first of all he should be a resident. First of all he should be a resident, and his age should be 80 or more, and note, and he should be a resident and his age should be 80 or more. Okay, so he should have attained the age of 80 at least, then only he will be called as super senior citizen. Okay, see, for the assessment year 2021, that is previous year 1920, if you want to call an individual as super senior citizen, you should have attained the age of 80 at least on 1st April 2020, first day of the assessment year. If he attains the age of 80 on 1st April 2020, okay, then he will be regarded as super senior citizen. So he could attain the age of 80 at any time during the previous year 1920, or even on 1st April 2020, the first day of the assessment year, then he will be called as super senior citizen. Age should be 80 or more, and he should be resident. Cumulative conditions. For a super senior citizen, the basic exemption limit is 5 lakhs. Up to 5 lakhs, no tax. Where the total income exceeds 5 lakhs but doesn't exceed 10 lakhs, then the tax rate is 20%. The tax rate is 20%. Where the total income exceeds 10 lakhs, then, okay, the excess over 10 lakhs, okay, the tax rate is 30%. That means up to 5 lakhs tax rate is 0. From 5 to 10 lakhs the tax rate is 20%. On the excess over 10 lakhs the tax rate is 30%. This is regarding the tax rates, slab rates applicable to a super senior citizen. Then come to senior citizen. Who is a senior citizen? First of all, he should be a resident and his age should be less than 80 and it should be 60 or more, and it should be 60 or more. He can attain the age of 60 at any time during the previous year 1920, or even on first day of the assessment year, that is 1st April 2020. Then he will be called as senior citizen. Here also the conditions are cumulative. He should be resident and the age should be less than 80 years, but it should be 60 or more. Okay. Then for a senior citizen, the slab rates are as under. The basic exemption limit is 3 lakhs. Up to 3 lakhs, the tax rate is nil. Above 3 lakhs up to 5 lakhs, the tax rate is 5%. That means up to 3 lakhs tax is nil. Above 3 lakhs up to 5 lakhs, on this additional income, the tax rate is 5%. Where the total income exceeds 5 lakhs but doesn't cross 10 lakhs, on the excess over 5 lakhs up to 10 lakhs, the tax rate is 20%. And where the total income exceeds 10 lakhs, on the excess over 10 lakhs, the tax rate is what? 30%. So up to 3 lakhs, tax rate is nil. Above 3 lakhs, up to 5 lakhs, on this incremental income, the tax rate is 5%. Above 5 lakhs, up to 10 lakhs, on that incremental income, the tax rate is 20%. Above 10 lakhs, on that incremental income, the tax rate is 30%. Fine. Then, the third category of individual are non-senior citizen. Okay, anybody who is not a super senior citizen, who is not a senior citizen, is a non-senior citizen. Is a non-senior citizen. For a non-senior citizen, okay, the tax rates are as under, the slab rates are as under. For the assessment year 2021, basic exemption limit is 2.5 lakhs. Up to 2.5 lakhs, tax rate is nil. Where the total income exceeds 2.5 lakhs but doesn't exceed 5 lakhs, on that incremental amount which is crossing 2.5 lakhs, the tax rate is what? 5%. Where the total income exceeds 5 lakhs but doesn't cross as 10 lakhs, then on the excess over 5 lakhs, the tax rate is 20%. Where the total income crosses 10 lakhs, on the excess over 10 lakhs, the tax rate is 30%. So to consolidate, on first 2.5 lakhs, tax rate is 0. Excess over 2.5 lakhs, okay, up to 5 lakhs, on that the tax rate is 5%. Excess over 5 lakhs up to 10 lakhs, the tax rate is 20%. Excess over 10 lakhs, the tax rate is 30%. So these are the tax rates applicable to individual. Sorry. What are the tax rates applicable for a Hindu undivided family? The tax rates applicable for Hindu undivided family are the same tax rates which are applicable to a non-senior citizen individual. Non-senior citizen individual. Then for artificial juridical person also, the slab rates are same as that of a non-senior citizen. Non-senior citizen. Then for AOP or BOI, for association of person or body of individuals, there is categorization this way. AOP or BOI covered by 167B, not covered by 167B, like this we are dividing. If the AOP or BOI is covered by section 167B, that AOP or BOI will suffer tax at maximum marginal rate. Maximum marginal rate. At times, even at a rate higher than the maximum marginal rate, or at a time, at some time, even at a combination of maximum marginal rate or higher rate, that is a part of the total income will suffer tax at maximum marginal rate. The other part will suffer tax at the higher rate. So, if the AOP or BOI is covered by 167B, then that AOP or BOI will suffer tax either at maximum marginal rate or even at a higher rate at sometimes, and at sometimes it will be suffering tax at combination of maximum marginal rate and higher rate. This is regarding AOP or BOI covered by 167B, which we will detailedly discuss in assessment of AOP or BOI. If the AOP or BOI is not covered by 167B, okay, it will suffer tax at the rates which are applicable to non-senior citizen. Applicable to non-senior citizen. So the consolidation is for non-senior citizen individual, for a Hindu undivided family, for artificial juridical person, and for AOP or BOI which is not covered by 167B, okay, the tax rates are same. The tax rates are same. So this you need to note. Next is, for a cooperative society, the tax rates are as under. Up to 10,000, the tax rate is 10 percentage. Above 10,000 up to 20,000 and the incremental portion the tax rate is 20%. Above 20,000 and the incremental portion the tax rate is 30%. So to consolidate, the total income up to 10,000 the tax rate is 10%. Where it crosses 10,000 but doesn't cross 20,000, okay, and the excess over 10,000 the tax rate is 20%. Where it crosses 20,000 and the excess over 20,000 the tax rate is 30%. This is the tax rate applicable for a cooperative society. Then the tax rate applicable for a firm, okay, including Indian LLP. Indian LLP is treated as firm only as per section 2 class 23. For a firm or Indian LLP, the tax rate is what? 30% flat. It is 30% flat. For a local authority, the tax rate is what? 30% flat. Okay, irrespective of the quantum of total income, the tax rate is 30%, 30%. Now come to company, corporate associates. For a company, the tax rates are as under. We divide a company into two categories: domestic company, foreign company. For a foreign company, the tax rate is 40%. There is no confusion only. For a foreign company, the tax rate is what? 40%. No confusion. For a domestic company, there are differential tax rates applicable. Okay, if a domestic company has exercised option under 115 BA, which I am going to discuss, then the tax rate is 25%. If the domestic company has exercised option under 115 BAA, then the tax rate is 22%. If the domestic company has exercised option under 115 BAB, okay, the tax rate is predominantly 15%, but some portion of the income may suffer tax even at the rate of 22% and 30%. Fine. Then where the domestic company has not exercised option under 115 BA or 115 BAA or 115 BAB, and the total income, the turnover or gross receipts for the previous year 17-18 doesn't cross 400 crores, then the tax rate is 25%. Where for that company the turnover or gross receipts for the year 17-18 crosses 400 crores, then the tax rate is 30%. The tax rate is 30%. So to consolidate the corporate tax rates, if the company is a foreign company, the tax rate is what? 40%. If the company is a domestic company which has exercised option under 115 BA, you should parallelly join me in revising. I may not be seeing you, I may not be hearing you, but okay, you should join me in revising things, then only it will register. Use this opportunity. Okay, if the company is a domestic company which has exercised option under 115 BA, then the tax rate is what? 25%. If the domestic company has exercised option under 115 BAA, the tax rate is what? 22%. If the domestic company has exercised option under 115 BAB, then the tax rate is primarily 15%, but some elements of income may suffer tax at the rate of 22%, some elements of income may suffer tax at the rate of 30%. But where the domestic company has not exercised option under 115 BA or BAA or 115 BAB, then the tax rate could be 25% or 30%. It all depends upon the turnover or gross receipts of that company for the previous year 17-18. The turnover or gross receipts of the company for the previous year 17-18 doesn't cross 400 crores, now the tax rate is 25%. It crosses 400 crores, now the tax rate is what? 30%. It is 30%. So these are the tax rates applicable for company. So what we have discussed till now, the tax rates applicable for individual, HUF, AOP, BOI, AJP. Then we have discussed the tax rates applicable for a cooperative society, firm, local authority. Then we discussed the tax rates applicable for the company. So you should have a list as to what we have discussed. Next is, okay, we are going to discuss the surcharge. We are going to discuss surcharge. So whatever we are discussing, everything is included in the typed material. Okay, that can help you in preparing as well as revising you very easily. Fine. Now we enter into the next discussion. That discussion is about surcharge. Listen to me. For the purpose of knowing surcharge, let us categorize the persons into three. First set of persons, individual, HUF, AJP, AOP, BOI. This is first category. Next category, firm including Indian LLP, cooperative society, local authority. This is second set. Third set, company. So what are the three categories? Join me. Individual, HUF, AJP, AOP, BOI. This is first set. Second set of persons, firm including Indian LLP, cooperative society, local authority. This is second set. Third set, and company. Okay. For the first set of persons, individual, HUF, AJP, AOP, BOI, for them the surcharge is as under. If the total income, okay, doesn't cross 50 lakhs, no surcharge. If the total income is crossing 50 lakhs but doesn't cross 100 lakhs, surcharge is what? 10%. If the total income is crossing 100 lakhs, doesn't cross 200 lakhs, surcharge is what? 15%. Where the total income is crossing 200 lakhs, doesn't cross 500 lakhs, surcharge is what? 25%. Where the total income is crossing 500 lakhs, surcharge is what? Okay, 37%. And this surcharge percentage should be applied on what? Tax. Should be applied on tax. So to consolidate before we proceed, for individual, HUF, AOP, BOI, AJP, okay, what is the surcharge? Up to 50 lakhs, the total income, if it doesn't cross 50 lakhs, no surcharge. If it is crossing 50 lakhs but doesn't cross 100 lakhs, surcharge rate is what? 10%. If it is crossing 100 lakhs, doesn't cross 200 lakhs, surcharge rate is what? 15%. If it is crossing 200 lakhs but doesn't cross 500 lakhs, surcharge rate is what? 25%. If it is crossing 500 lakhs, the surcharge rate is what? 37%. So this you need to understand. This is the surcharge rate applicable to individual, HUF, AJP, AOP, BOI. Then we will learn the surcharge rate applicable to the next set of persons. They are next set of persons, firm including Indian LLP, cooperative society, local authority. For them, okay, the surcharge rates are as under. Where we will discuss this way, where total income of cooperative society, local authority, okay, cooperative society, local authority or firm including Indian LLP doesn't exceed 100 lakhs, no surcharge, no surcharge. Where, okay, the total income exceeds 100 lakhs, surcharge rate is what? 12%. Simple. For a cooperative society, firm, local authority, Indian LLP, there will be no surcharge if the total income doesn't cross 100 lakhs. If it crosses 100 lakhs, surcharge rate is what? 12%. Surcharge rate is flat 12%. The surcharge percentage should be applied on what? The tax. Fine. Then for companies, okay, third set of persons here, we discuss the surcharge rate applicable for individual, HUF, AJP, AOP, BOI. Next we discuss the surcharge rate applicable for firm including Indian LLP, cooperative society, local authority. Now we are going to discuss the surcharge rate applicable for corporate associates. We will divide company into two categories, foreign company, domestic company. For a foreign company, the surcharge rates are as under. Where the total income doesn't cross 100 lakhs, there is no surcharge. Where it crosses 100 lakhs but doesn't exceed 1000 lakhs, but doesn't exceed what? 1000 lakhs. Then the surcharge rate is 2%. The surcharge rate is what? 2%. Where the total income exceeds 1000 lakhs, then the surcharge rate is what? 5%. To consolidate, join me here, for a foreign company, okay, what are the surcharge rates? Up to 100 lakhs, the total income doesn't exceed 100 lakhs, then there is no surcharge. If it is exceeding 100 lakhs, doesn't exceed 1000 lakhs, then the surcharge rate is what? 2%. Surcharge rate is 2%. Where it exceeds 1000 lakhs, total income exceeds 1000 lakhs, then the surcharge rate is what? 5%. Fine. Sorry. Next, come to domestic company. Domestic company divided into two categories for learning surcharge. One is domestic company which has exercised option under 115 BAA or 115 BAB. Domestic company which has exercised option under 115 BAA or 115 BAB. For that domestic company, surcharge rate is what? 10%. For all other domestic companies, there will be no surcharge if the total income doesn't exceed 100 lakhs. If the total income exceeds 100 lakhs but doesn't exceed 1000 lakhs, surcharge rate is what? 7%. If the total income exceeds 1000 lakhs, then the surcharge rate is 12%. So to consolidate the surcharge rates applicable for a domestic company, let us divide domestic company into two categories. Domestic company which has exercised option under 115 BAA or 115 BAB. For those domestic companies, irrespective of the quantum of total income, the surcharge rate is 10%. Surcharge rate is 10%. For all other domestic companies, there will be no surcharge if the total income doesn't exceed 100 lakhs. If it exceeds 100 lakhs but doesn't exceed 1000 lakhs, then the surcharge rate is what? 7%. If the total income exceeds 1000 lakhs, then the surcharge rate is what? 12%. This is the surcharge rate applicable for domestic companies. We already discussed for foreign company. So this is the next topic, surcharge. But this is not simple. There are some nuances here. See, to discuss the point which I am going to discuss, there is some prerequisite. You should recollect three things. You should recollect three things. Why I am using the word recollect? Because this is primarily a revision batch. Fast track revision. Long term capital gains referred to in 112A. Then you should recollect what is short term capital gains referred to in 111A. Then you should recollect what is capital gains referred to in 115 AD subsection 1 class B. So first of all, let us recollect that, then we will go to that additional point. Where the capital asset transferred is equity shares. Where the capital asset transferred is equity shares and it is a long term capital asset, and at the time of acquiring these shares, STT was suffered, securities transaction tax was suffered, and at the time of transfer also STT was suffered, securities transaction tax was suffered. Then the resultant capital gain is a long term capital gain covered by 112A. Where the capital asset is equity oriented units of mutual fund and it is a long term capital asset, and you have suffered STT at the time of transfer. Then the resultant long term capital gain is one covered by 112A. Where the capital asset is units of business trust, okay, and it is a long term capital asset, and at the time of transfer you suffered STT, then the resultant long term capital gain is long term capital gain referred to in 112A. To consolidate, where the capital asset transferred is equity shares and it is a long-term capital asset, and at the time of acquisition as well as at the time of transfer, okay, of these equity shares, the assessee has suffered securities transaction tax. Then the resultant long-term capital gain is one which is covered by 112A. Sorry. Where the capital asset is equity oriented units of mutual fund and it is a long-term capital asset and STT is suffered at the time of transfer, then the resultant long-term capital gain is also one covered by 112A, where the capital asset is units of business trust, and it is a long-term capital asset, and at the time of transfer the assessee has suffered STT, then the resultant long-term capital gain is one covered by 112A. Sorry. Next is, you should recollect what is short-term capital gain under 111A. Short-term capital gain under 111A I am discussing. The capital asset transferred is equity shares or equity oriented units of mutual fund or units of business trust, and the capital asset is a short-term capital asset. STT was suffered at the time of transfer, then the resultant short-term capital gain is one covered by 111A. To consolidate, capital asset transferred should be either equity shares or equity oriented units of mutual fund or units of business trust, and the capital asset transferred is a short-term capital asset. Upon transfer, STT was suffered, then the resultant short-term capital gain is one covered by 111A. So this is short-term capital gains covered by 111A. Next is, okay, capital gains referred to in 115 AD subsection 1 class B. What is capital gain referred to in 115 AD subsection 1 class B? Listen, where the assessee is a foreign institutional investor, FII na foreign institutional investor or foreign portfolio investor, okay, then the funds mobilized by the FII or FPI from its investors are invested in securities, Indian securities, which are capital asset, and if these securities are transferred, the resultant capital gain is one coming under 115 AD subsection 1 class B. What is capital gain referred to in 115 AD subsection 1B, 115 AD subsection 1B, where the assessee is a foreign institutional investor or foreign portfolio investor. If it is transferring the securities in which it has invested, the resultant capital gain is one covered by 115 AD subsection 1 class B, So thus you need to have clarity as to what is long-term capital gain referred to in 112A, what is short-term capital gains referred to in 111A, and what is capital gain referred to in 115 AD subsection 1 class B. Fine. This is prerequisite for, okay, what I am going to discuss. Listen, the surcharge rate of 25% and 37%, before that recollect, for an individual HUF, AOP, BOI, AJP, there are four surcharge rates possible. What are they? 10%, 15%, 25%, 37%. How many surcharge rates? Join me. 4. 10, 15, 25, 37. Where the total income doesn't cross 50 lakhs, no surcharge. Where the total income crosses 50 lakhs but doesn't cross 100 lakhs, surcharge rate is 10%. Crosses 100 lakhs, doesn't cross 200 lakhs, surcharge rate is what? 15%. crosses 200 lakhs but doesn't cross 500 lakhs, 25%. Crosses 500 lakhs, surcharge rate is 37%. This you should recollect. Fine. Now in this background, read this. The surcharge rate of 25 and 37 shall not apply to capital gain arising on sale of equity shares in a company or unit of an equity oriented fund or unit of business trust referred to in 111A or 112A. The surcharge rate of 25% and 37% shall also not apply to income of foreign institutional investors from securities as referred to in 115 AD, subsection 1 class B. Subsection 1 class B. This is what given here. Okay, the summary is this way. Okay, for an individual, okay, linking what we have already discussed and what we are now discussing, both of the combined picture is this. That is, this is the summary of the surcharge rates applicable for individual, HUF, AOP, BOI, AJP. For these persons, if the total income doesn't cross 50 lakhs, no surcharge. If the total income crosses 100 lakhs but doesn't crosses 50 lakhs, doesn't cross 100 lakhs, surcharge rate is 10%. Where the total income is crossing 100 lakhs, doesn't cross 200 lakhs, then the surcharge rate is what? 15%. But where the total income is crossing 200 lakhs, crossing what? 200 lakhs, then the long-term capital gain referred to in 112A, short-term capital gains referred to in 111A, the capital gains referred to in 115 AD, subsection 1 class B, that shall suffer tax only at surcharge only at the rate of 15%. Other income, if it doesn't cross 200 lakhs, surcharge rate is 15%. Other income crosses 200 lakhs, doesn't cross 500 lakhs, the surcharge rate is 25%. Other income crosses 500 lakhs, surcharge rate is what? 37%. I am consolidating. Listen here. Where the total income of an individual, HUF, AOP, BOI, AJP doesn't cross 50 lakhs, no surcharge. Crosses 50 lakhs, doesn't cross 100 lakhs, surcharge rate is 10%. Crosses 100 lakhs, doesn't cross 200 lakhs, surcharge rate is 15%. This confusion. But where it is crossing 200 lakhs, from now onwards you should be careful. Crossing 200 lakhs, total income is crossing 200 lakhs. Then bifurcate the total income into two parts. Okay, long-term capital gains covered in 112A, short-term capital gains covered in 111A, then capital gains referred to in 115 AD, subsection 1 class B. This is one set. Other income, this is another set. What you should do? If the total income crosses 200 lakhs, divide that into two. Long-term capital gains covered by 112A, short-term capital gains covered by 111A, capital gains covered by 115 AD, subsection 1 class B. This is one set. Other income, another set. So, for the long-term capital gains covered under 112A, short-term capital gains covered by 111A, capital gains covered by 115 AD, subsection 1 class B, for them, for this income, the surcharge rate will be 15%. Will be what? 15%. But the other income surcharge rate is, other income for that surcharge rate will be 15% when the other income doesn't cross 200 lakhs. If the other income crosses 200 lakhs, doesn't cross 500 lakhs, for the other income the surcharge rate is 25%. Where the other income crosses 500 lakhs, the surcharge rate is what? 37%. That is, the surcharge rate for other income alone varies. Okay, after the total income crosses 200 lakhs, the surcharge rate for long-term capital gains referred to in 112A, short-term capital gains covered by 111A, capital gains covered by 115 AD, subsection 1 class B, it will be only 15%. It will not jump thereafter. It will stay there only. Fine. Now, consolidation, join me. We are now discussing the surcharge rate applicable to individual HUF, AOP, BOI, AJP. Okay, tell me, where the total income doesn't cross 50 lakhs, will there be surcharge? No. If the total income is crossing 50 lakhs, doesn't cross 100 lakhs, will there be surcharge? Yes. At what rate? 10%. If the total income is crossing 100 lakhs, doesn't cross 200 lakhs, surcharge rate is what? 15%. Up to this, no confusion. But where the total income is crossing 200 lakhs, then irrespective of the quantum of total income thereafter, for long-term capital gains covered by 112A, short-term capital gains covered by 111A, for the capital gains covered by 115 AD subsection 1 class B, the surcharge rate will be only 15%. But for other income, the surcharge rate will be 15%, 25% or 37% depending upon the quantum of the other income. If the other income doesn't cross 200 lakhs, surcharge rate is 15%. If the other income is crossing 200 lakhs, doesn't cross 500 lakhs, surcharge rate applicable for other income is 25%. Where the other income crosses 500 lakhs, the surcharge rate applicable for other income is 37%. One thing is sure, for long-term capital gains covered by 112A, short-term capital gains covered by 111A and capital gains covered by 115 AD subsection 1 class B, surcharge rate cannot be more than 15%. Maximum it could be only 15%. Thereafter it can never become 25% or 37%. That you need to note. Sorry. Now to visualize, I'll give you few illustrations. You see this. Keep the table which I have shown with you and see this in the screen. Illustration number 1. Assess is Mr. C. He is a non-senior citizen. Assess is Mr. C. He is a non-senior citizen. Assessment year is 2021. Total income is 201 lakhs. In the total income, what are all the components? Let us see. Long-term capital gains covered by 112A is 41 lakhs. Short-term capital gains covered by 111A is 40 lakhs. Other income is 120 lakhs. So these are all the basic facts. Who is the assessee? C. What is the assessment year? 2021. Total income is what? 201 lakhs. Is there any breakup for that? Yes. Total income is having 3 elements. Long-term capital gains covered by 112A, how much? 41 lakhs. Short-term capital gains covered by 111A, how much? 40 lakhs. Other income, how much? 120 lakhs. Fine. These are the composition of the total income. Sorry. We will come to surcharge subsequently. Before that, we need to compute tax. Fine. Long-term capital gains covered by 112A will suffer tax at the flat rate of 10%. But first 1 lakh will not suffer tax. Excess will suffer tax at the rate of 10%. Abdina, in this 41 lakhs, 1 lakh will not suffer tax. Okay, the excess 40 lakhs is there. That will suffer tax at the rate of 10%. So the tax is 41 lakhs minus 1 lakh, 40 lakhs on that 10% is 4 lakhs. Then short-term capital gains under 111A will suffer tax at the flat rate of 15%. So 40 lakhs, 15% is what? 6 lakhs. That is the tax. Other income 120 lakhs, that will suffer tax at slab rates. That 0 to 2.5 lakhs, 0. Okay, and above 2.5 lakhs up to 5 lakhs, 5%. Above 5 lakhs up to 10 lakhs, 20%. Above 10 lakhs, 30%. That slab rate will apply. So thus we have computed tax on this, and this. And that sums up to 44 lakhs 12,500. So 44 lakhs 12,500 is the tax on this total income. Now I need to add surcharge. surcharge. Let us apply the table I am showing. Okay, assess here individual. Total income not crossing 50 lakhs, no. Not crossing 100 lakhs, no. Not crossing 200 lakhs, no. Is it crossing 200 lakhs? Yes. In a total income is 201 lakhs, correct? So it is crossing 200 lakhs. Sorry. Now we should be careful. We shall bifurcate the total income into two parts. Long-term capital gains covered by 112A and short-term capital gains covered by 111A. This is one set. Next is other income, another set. For the long-term capital gains covered by 112A and short-term capital gains covered by 111A, the surcharge rate can never be more than 15%. Okay, general surcharge rate up to 50 lakhs no surcharge, above 50 lakhs up to 100 lakhs 10%, above 100 lakhs up to 200 lakhs 15%, above 200 lakhs up to 500 lakhs 25%, above 500 lakhs 37%. This is the general surcharge rate, correct? But here the total income is having long-term capital gains covered by 112A, short-term capital gains covered by 111A, correct? So on this category of income, the surcharge rate can never cross 15%. It can never cross 15%. So therefore, tax on this capital gain, 4 plus 6, 10. On that we can apply only 15% surcharge. We can apply only 15% surcharge. Sorry. Come to the other income. Total income is crossing 200 lakhs. Other income is not crossing 200 lakhs. Other income is only 120. Then also the surcharge rate applicable for other income is what? 15%. So on the tax on other income, 34 lakhs 12,500 also, we shall apply only 15%. We shall apply only 15%. So to consolidate the entire discussion, this is a case where total income is crossing 200 lakhs. Then the surcharge on long-term capital gains covered by 112A and short-term capital gains covered by 111A cannot cross 15%. It has to be only 15%. So tax on this long-term capital gain and tax on this short-term capital gain put together is 10 lakhs. 10 lakhs 15% is the surcharge. Come to the other income. Other income doesn't cross 200 lakhs. Doesn't cross 200. So the tax on other income will also suffer tax surcharge only at the rate of 15%. Only at the rate of 15%. That you need to note. Come to illustration number 2. Okay, import the facts from illustration 1, but the following are the changes. Long-term capital gain covered by 112A is what? 81. Short-term capital gains is what? 40. Other income is what? 80 lakhs. In this case, how do we compute the surcharge? Very simple. Total income is more than 200 lakhs. Yes. The long-term capital gains covered by 112A and short-term capital gains covered by 111A will suffer surcharge at what rate? 15%. So on 81 lakhs, what is the tax? First 1 lakh, ignore. Next 80 lakhs will suffer tax at the rate of 10%. Short-term capital gains covered by 111A, 40 lakhs will suffer tax at what rate? 15%. Other income 80 lakhs will suffer tax at what rate? Slab rates. Okay, that is there. So the total tax is this much. How do we compute surcharge? How do we compute surcharge on this tax? That is long-term capital gains. On that, what is the tax? Okay, it is 8 lakhs. On short-term capital gains, what is tax? 6 lakhs. 8 plus 6 what? 14. On 14, what is the percentage? 15%. Now the other income is what? 80. Other income is less than 200 lakhs. So the surcharge rate is what? 15%. Surcharge rate is 15%. Hey, see this illustration here. The total is 201 lakhs. That has not changed. But the composition only has undergone a change. Long-term capital gain referred to in 112A is what? 81. Short-term capital gains referred to in 111A is what? 40. Other income is what? 80. So the tax on this long-term capital gain is what? Okay, first 1 lakh not taxable. Next 80 lakhs is taxable at the rate of 10%. Here this 40 lakhs is taxable at the rate of 15%. This 80 lakhs is taxable at the rate of slab rates. Now surcharge, total income crosses 200 lakhs. Long term capital gains and short term capital gains, that is long term capital gains covered by 112A and short term capital gains covered by 111A, these two will suffer tax only at the rate of surcharge at the rate of 15%. So the tax on this long term capital gain 8 lakhs, the tax on this short term capital gain 6 lakhs. So total tax is 14. On the surcharge rate is what, 15%. Then the tax on other income, okay, will suffer surcharge at the rate of 15% because other income has not crossed 200 lakhs. Has not crossed 200 lakhs. This is illustration number 2. Illustration number 3. Assessee is C. Assessment year is 2021. Assessment year is 2021. Total income is 401 lakhs. How much? 401 lakh. Idhila long term capital gains covered by 112A is 351 lakhs. Other income is 50 lakhs. Other income is 50 lakhs. First let us compute tax. On 350 lakhs, first 1 lakh is not taxable. Extra 350 lakhs is to suffer tax at what rate? 10%. Is to suffer tax at what rate? 10%. Other income of Mr. C, who is a non-senior citizen, shall suffer tax at what rate? Slab rates. Shall suffer tax at what rate? Slab rate. So we have computed tax. Now we need to compute surcharge. We need to compute surcharge. Listen, don't get distracted. The surcharge, listen to me, total income crossed 200 lakhs. Yes. Then the long term capital gain covered by 112A, short term capital gains covered by 111A, included in this total income, that will suffer tax only at a maximum rate of what? 15. Will suffer surcharge at what rate? Maximum of 15%. Other income 50 lakhs. That is less than what? 200 lakhs. Then the tax on the other income will also suffer tax only at what rate? 15%. Will suffer surcharge at what rate? 15%. So that way you need to understand. So final consolidation is this. If the total income crosses 200 lakhs, then in that total income there may be long term capital gains covered by 112A, short term capital gains covered by 111A, or capital gains covered by 115 AD subsection 1 class B. The tax on that long term capital gain will suffer surcharge only at the rate of 15%. Then the tax on other income will suffer surcharge at the rate of 15% or 25% or 37% depending upon the quantum of other income. Other income doesn't cross 200 lakhs, 15%. Crosses 200 lakhs, doesn't cross 500 lakhs, 25%. Crosses 500 lakhs, the surcharge rate is 37%. This is the surcharge rates applicable for different categories of assessees. Then after surcharge there is health and education cess. Health and education cess is leviable at the rate of 4% for all assessees irrespective of their level of income. Okay, it is 4%. This 4% should be applied on what? Tax plus surcharge. A tax percentage should be applied on total income. Surcharge percentage should be applied on tax. And health and education cess percentage is to be applied on tax plus surcharge. Tax plus surcharge. It is 4% applicable to all assessees. So thus we have learnt about what? Surcharge. We have learnt about surcharge. Now we are going to discuss two more things. Rebate under 87A. Rebate under 87A. Who is eligible for rebate under 87A? See this. Section 87A is providing rebate only to an individual, not to any other person. And that too, that individual should be resident. So to an individual who is a resident and whose total income doesn't cross 5 lakhs, rebate is provided. So who is entitled to rebate under 87A? Assessee should be an individual, should be a resident. And the total income should not cross 5 lakhs. These are the 3 cumulative conditions. If these conditions are satisfied, this assessee is entitled to a rebate. Rebate under which section? 87A. What is the quantum of rebate? Tax are 12,500, whichever is less. That is tax before adding health and education cess. Tax, income tax are 12,500, whichever is less will be the quantum of rebate. What we shall do with this rebate? Reduce it against the tax. Then we will get what? Tax plus rebate. Then to that we shall add health and education cess. Then we get the tax liability. To consolidate, who is entitled to rebate? Only an individual who is a resident whose total income doesn't cross 5 lakhs. What is the quantum of rebate? Income tax are 12,500, whichever is less. What is the tax treatment of rebate? From tax, you should reduce the rebate under 87A. Then you will get tax after rebate. Then to that you should add health and education cess at the rate of 4%. Fine. Now, there is fourth point important. What is given here? 87A rebate is not available against tax on long-term capital gains referred to in 112A. Rebate under 87A is not available against the tax on what? Long-term capital gain referred to in 112A. Referred to in what? 112A. So to visualize this, I'll give you one illustration. See this. Assessee is Mr. C, is a resident, is a non-senior citizen. Assessment year is 2021. His total income is 5 lakhs, which includes long-term capital gain referred to in 112A. What? How much? 2.5. Other income, how much? Balance 2.5 lakhs. So, facts in Mr. C is a resident, is a non-senior citizen. Assessment year is 2021. Total income is 5 lakhs, which is having a breakup of 2 elements. Long-term capital gains covered by 112A, which is 2.5 lakhs. Other income, how much? 2.5 lakhs. Correct? Fine. Now, first of all, let us compute the tax on this long-term capital gains covered by 112A. First 1 lakh not taxable. Extra 1.5 lakhs is taxable at what rate? 10%. Then the tax comes to 15,000. Then the other income 2.5 lakhs. 2.5 lakhs doesn't cross the basic exemption limit. So therefore, the tax is 0 on other income. So the tax on 5 lakhs is what? 15,000. It is 15,000. Now, assess here, individual, yes. Is a resident, yes. Total income is 5 lakhs. 5 lakhs doesn't cross 5 lakhs, yes. Okay, so generally is entitled to rebate under 87A, yes. But the tax is what? Tax on long-term capital gain covered by 112A. So against that, rebate is not available. Mukku vatam, you should not reduce 12,500 as a rebate. No. Why? Rebate under 87A is not available against tax on long-term capital gains covered by 112A. So this illustration you should use it for understanding rebate under 87A. So thus we are through with rebate under 87A also. Next discussion is marginal relief. Listen to me. The format for computation of tax liability where the assessee is having surcharge is this. Tax plus surcharge then we get tax plus surcharge. You should see whether marginal relief benefit is available. You should see whether marginal relief benefit is available. If it is available, you should reduce it. Then what we get is tax plus surcharge after marginal relief. Then to that we shall add health and education cess at the rate of 4%. This is the format for computation of tax liability where the assessee is having surcharge. First we shall compute tax, then add surcharge, then we get tax plus surcharge, reduce marginal relief, we get tax plus surcharge after marginal relief, add health and education cess, we get the final tax liability. So therefore, you should know how to quantify marginal relief. So for the purpose of marginal relief computation, persons are divided into three categories. Category 1, individual, HUF, AOP, BOI, AJP, one set. Firm, cooperative society, local authority, firm nale including Indian LLP, company, their breakup, for domestic company, foreign company. So we shall know as to how to compute margin relief for these persons, and how to compute margin relief for domestic company, foreign company. So we will learn the format for computation of marginal relief for these assessees. Fine. First, computation of marginal relief, MR9, marginal relief. In case of individual, HUF, AJP, AOP, BOI, not covered by 167B, how do we compute marginal relief? Simple. There are four possibilities. The total income crosses 50 lakhs. Total income crosses 100 lakhs. Total income crosses 50 lakhs, doesn't cross 100 lakhs. This is possibility 1. Total income crosses 100 lakhs but doesn't cross 200 lakhs. Total income crosses 200 lakhs but doesn't cross 500 lakhs. Total income crosses 500 lakhs. Thus, there are four situations. Okay, in computing marginal relief in case of an individual, HUF, AOP, BOI, AJP. First scenario eduthukalam. Total income crosses 50 lakhs, doesn't cross 100 lakhs. Then how do we compute marginal relief? Step 1. Tax on total income. Okay, compute. Add surcharge at the rate of 10%. Why? Because if the total income is more than 50 lakhs, not more than 100 lakhs, surcharge rate is what? 10%. So tax on total income plus surcharge at the rate of 10%, that you ascertain. Next, you ascertain tax on 50 lakhs. Then you find the difference between total income and 50 lakhs. Then marginal relief is equal to 1 minus 2 minus 3. Marginal relief is 1 minus 2 minus 3. What is 1? Tax on total income plus surcharge at the rate of 10%. What is 2? Tax on 50 lakhs. What is 3? Total income minus 50 lakhs. So come to the next situation where the total income is more than 100 lakhs, not more than 200 lakhs. In this case, how do we compute marginal relief? Same format, 1 minus 2 minus 3. But what is 1? Tax on total income plus surcharge. But surcharge will not be at the rate of 10%. Surcharge will be at the rate of 15%. Why? The total income has crossed 100 lakhs but doesn't cross 200 lakhs. Doesn't cross 200 lakhs. So first step is tax on total income plus surcharge at the rate of 15%. Then we need to compute tax on 100 lakhs. Tax on 100 lakhs. But when you compute tax on 100 lakhs, okay, you need to add surcharge at the rate of 10%. Because when the total income is 100 lakhs, surcharge will come at the rate of 10%. Na? Yes. So step number 2 is what? Tax on 100 lakhs. Add surcharge at the rate of 10%. Then step number 3 is what? Total income minus 100 lakhs. So what is margin relief? 1 minus 2 minus 3. Hey, join me. What is step number 1 in situation number 2? Tax on total income plus surcharge at the rate of 15%. What is step number 2? Tax on 100 lakhs plus surcharge at the rate of 10%. Then what is step number 3? Total income minus 100 lakhs. What is step number 4? Marginal relief, which is 1 minus 2 minus 3. So what we are discussing is computation of marginal relief in case of an individual HUF, AOP, BOI or AJP. So there scenario number 3 is total income crosses 200 lakhs but doesn't cross 500 lakhs. What is marginal relief? 1 minus 2 minus 3. What is step number 1? Tax on total income but plus surcharge will be at the rate of 25%. Why? The total income has crossed 200 lakhs but doesn't cross 500 lakhs. Then in step number 2, tax on 200 lakhs. Okay, 200 lakhs, the surcharge should be added at the rate of what? 15%. Then tax on, find the difference between total income and 200 lakhs. That is step number 3. Marginal relief is 1 minus 2 minus 3. So what is 1? Tax on total income plus surcharge at the rate of 25%. What is step number 2? Tax on 200 lakhs plus surcharge at what rate? 15%. Step number 3 is what? Total income minus 200 lakhs. Step number 4 is what? Marginal relief, which is 1 minus 2 minus 3. Scenario number 4. The total income has crossed 500 lakhs. Then how do we compute marginal relief? Same format. 1 minus 2 minus 3. 1 minus 2 minus 3. What is 1? Tax on total income plus surcharge at the rate of 37% because the total income has crossed 500 lakhs. What is step number 2? Tax on 500 lakhs plus surcharge at the rate of 25%. Up to 500 lakhs surcharge rate is only 25%. Na? So that's why. Then step number 3 is what? Total income minus 500 lakhs. What is marginal relief? Okay, 1 minus 2 minus 3. So to consolidate, in situation number 1, what is step number 1? Tax on total income plus surcharge at the rate of 37%. What is step number 2? Tax on 500 lakhs plus surcharge at the rate of 25%. What is step number 3? Total income minus 500 lakhs. What is that? Marginal relief 1 minus 2 minus 3. Thus, we have learned marginal relief computation for an individual HUF, okay, AJP, AOP or BOI not covered by 167B. Second, we are now going to discuss marginal relief computation in case of a cooperative society, local authority, firm including Indian LLP, There step number 1 is what? Tax on total income plus surcharge at the rate of 12%. Step number 2, tax on 100 lakhs. Up to 100 lakhs there is no surcharge, therefore there is no question of adding surcharge. Step number 3, total income minus 100 lakhs. Step number 4, marginal relief, which is 1 minus 2 minus 3. So how do we compute marginal relief for a cooperative society, firm, local authority? Step 1, tax on total income plus surcharge at the rate of 12%. Step number 2, tax on 100 lakhs. Step number 3, total income minus 100 lakhs. Okay, step number 4, marginal relief, which is 1 minus 2 minus 3. Next is computation of marginal relief in case of domestic companies. In case of what? Domestic companies. Here there are two scenarios possible. The total income of the domestic company crosses 100 lakhs but doesn't cross 1000 lakhs. No, it has crossed 1000 lakhs. Where the total income of the domestic company crosses 100 lakhs, doesn't cross 1000 lakhs. Step 1, find tax on total income. Add surcharge at the rate of 7%. Because if the total income is more than 100 lakhs but not crossing 1000 lakhs, surcharge rate is what? 7%. Step number 2, find tax on 100 lakhs. There is no question of adding surcharge here because up to 100 lakhs there is no surcharge. Then find the difference between total income and 100 lakhs. Total income and 100 lakhs. And what we get is marginal relief. What we get is marginal relief. Fine. So to consolidate, where the total income is not crossing 100 lakhs, not crossing 1000 lakhs, step 1 is what? Tax on total income plus surcharge at the rate of 7%. Step number 2, tax on 100 lakhs. Step number 3, total income minus 100 lakhs. And what is marginal relief? 1 minus 2 minus 3. Then scenario number 2, where the total income of the domestic company is crossing 1000 lakhs, then tax on total income plus surcharge at the rate of 12%. Why 12? Because the total income is crossing 1000 lakhs, surcharge rate is 12%. Step number 2 is tax on 1000 lakhs. Up to 1000 lakhs, surcharge rate is what? 7%. So you should add surcharge at the rate of 7%. Step number 3, total income minus 1000 lakhs. Total income minus 1000 lakhs. Marginal relief is 1 minus 2 minus 3. To consolidate, in scenario number 2, where the total income of the domestic companies cross 1000 lakhs, tax on total income plus surcharge at the rate of 12%. Step number 2, tax on 1000 lakhs plus surcharge at the rate of 7%. Step number 3 is total income minus 1000 lakhs. Step number 4, marginal relief 1 minus 2 minus 3. For a foreign company, I need not repeat. Same format as applicable for domestic company, but wherever you find 7%, substitute by 2. Wherever you find 12%, you substitute by 5. That's all. Here 7 substituted by 2, 12 substituted by 5. But for that, same. 7 substitute by 2, 12 substitute by 5. But here the rates are different. It could be 40, it could be 30%, it could be 25%, it could be 22%, or it could be 30%, or it could be 15% here. Different rates possible for domestic companies. But for foreign company, the tax rate is only 40%. So go through this, nothing there. So thus, we have completed marginal relief. Marginal relief. Now we enter into the next discussion, scheme of partial integration. Scheme of partial integration. What is scheme of partial integration? Where the assessee is having agricultural income. When I say agricultural income, I mean only Indian agricultural income. Indian agricultural income. That is exempt under 10 class 1. That is exempt under 10 class 1. However, though the agricultural income is exempt, in case of certain assessees, it will have an impact on computing the tax on non-agricultural income. In case of certain assessees, it enhances the rate at which the non-agricultural income is going to suffer tax. So in case of certain assessees, though agricultural income is exempt under 10 class 1, it will boost the rate at which the non-agricultural income of such assessee is going to suffer tax. It will enhance the rate at which the non-agricultural income of the assessee is going to suffer tax. So scheme of partial integration is nothing but the manner of computation of tax on non-agricultural income, where the assessee is also having agricultural income. So one line summary: scheme of partial integration is nothing but manner of computation of tax on non-agricultural income, where the assessee is also having agricultural income. Though agricultural income is exempt under a 10 class 1, it boosts the rate at which the non-agricultural income is going to suffer tax, and that is achieved through the scheme of partial integration. So in scheme of partial integration, following are the steps. Step 1, find out the tax on the sum total of agricultural income and non-agricultural income. Find the tax on sum total of agricultural income and non-agricultural income. This is step number 1. Step number 2, find the tax on sum total of agricultural income and basic exemption limit. Step number 3 is tax on non-agricultural income, which is step number 1 minus step number 2. That is tax in step 1 minus tax in step 2. Then we shall add surcharge. If the non-agricultural income is more than 50 lakhs, then we will add health and education cess at the rate of 4%, and we get the ultimate tax liability. So what are all the steps involved in scheme of partial integration? Number 1, find tax on the sum total of agricultural income and non-agricultural income. Step 2, find tax on the sum total of agricultural income and basic exemption limit. Step 3, step 1 minus step 2, that is tax on non-agricultural income. Then add surcharge only when the non-agricultural income is crossing 50 lakhs. Then add health and education cess at the rate of 4%. What we get is the tax liability when we follow scheme of partial integration. Fine. When the scheme of partial integration doesn't apply, if the assessee is a firm, or if assessee is a company, or if assessee is a local authority, assessee is a cooperative society, assessee is an AOP, assessee is body of individual, covered by 167B, then the scheme of partial integration doesn't apply. Simply ignore the agricultural income, it is exempt. It has no bearing on computation of tax on non-agricultural income. The aforesaid steps will not hold good. Simply compute tax only on non-agricultural income by applying the relevant tax rates. So for whom scheme of partial integration will not apply? For a firm, for a company, for local authority, for a cooperative society, for AOP or BOI not covered by 167B, scheme of partial integration doesn't apply. Agricultural income is exempt under 10 class 1. It is simply to be ignored. We shall only apply the rates applicable for non-agricultural income on the non-agricultural income. The aforesaid steps will not hold good. That means the scheme of partial integration can have relevance only to whom? Individual, HUF, AJP and AOP or BOI not covered by 167B. For whom it may apply? Individual, HUF, AOP or BOI not covered by 167B and AJP. For them also the scheme of partial integration will not apply where the non-agricultural income doesn't exceed the basic exemption limit. Where non-agricultural income itself is less than basic exemption limit, tax liability is 0. Scheme of partial integration doesn't apply. Where the net agricultural income, net of expenses, agricultural income net of expenses, doesn't cross 5,000, then also the scheme of partial integration doesn't apply. So if the assessee is a firm, company, cooperative society or local authority or AJP or AOP covered by 167B, scheme of partial integration will not apply. Where the non-agricultural income doesn't exceed the basic exemption limit, scheme of partial integration will not apply. Where the net agricultural income doesn't cross 5,000, the scheme of partial integration doesn't apply. Simply ignore the agricultural income. In a normal fashion, compute tax on non-agricultural income. Fine. Next is disintegration of composite income into agricultural and non-agricultural income. Where the assessee carries on composite business like growing and manufacturing tea in India, where the assessee is carrying composite business of growing and manufacturing tea in India. Growing represents agricultural activity, manufacturing non-agricultural activity. Growing and manufacturing tea in India. In India, this is important. Then this composite business income is to be disintegrated into two: agricultural element, non-agricultural element. Agricultural element is exempt under 10(1). Non-agricultural income is taxable under the head PGBP. Okay, so what is the agricultural element? What is the non-agricultural element? Agricultural element 60%, non-agricultural element is 40%. This is exempt under 10 class 1. This is taxable under the head PGBP. However, this may be considered for the scheme of partial integration if it could apply. So to consolidate, where the composite business is growing and manufacturing tea in India, Rule 8 says, in that composite business income, there are two elements: agricultural element, non-agricultural element. Agricultural element is 60%, which is exempt under 10 class 1. However, it may be considered for the scheme of partial integration if it could apply. Non-agricultural income is 40%, which is taxable under the head PGBP. But if you are having a tea estate in Malaysia, this division into 60-40 doesn't arise. Entire income will become taxable if it is otherwise taxable. This rule 8 is applicable only when the growing and manufacturing of tea is in India. And further, where assessee is only just engaged in cultivating tea, plucking the tea leaves and sell them, he doesn't manufacture tea, plucks the tea leaves and sells. He is having a tea estate, cultivates tea, and tea leaves are plucked, sold. No non-agricultural activity is carried out. Whatever that is carried out is only agricultural activity. Then there is no need to disintegrate the income into agricultural and non-agricultural. 60-40 will not apply because the entire activity is only growing, plucking and selling the tea leaves. So therefore, in that case, fully it is agricultural income. It is exempt. Sorry, where the composite business is growing and manufacturing rubber in India. Growing and manufacturing what? Rubber in India. Then in the composite business, agricultural element is 65%, non-agricultural element is 35%. This is exempt under 10(1). This is taxable under the head PGBP. This is considered for the scheme of partial integration. This is as per Rule 7A. Rule 7A. Where the assessee is growing and curing coffee, then in that case 25% is non-agricultural, 75% is agricultural. The composite business of the assessee is growing and curing coffee in India. Growing and curing coffee in India. Then in that composite business income, 75% is agricultural income exempt under 10(1). 25% is non-agricultural element, that is taxable under the head PGBP. This is as per Rule 7B, Sub Rule 1, where the assessee doesn't stop with curing. He is curing them, roasting, grounding, okay, in India, okay, and with or without mixing chicory or other flavoring ingredients. Then in that case, since the non-agricultural activities are more, okay, the non-agricultural component is 40, agricultural component is 60. This is taxable under the head PGBP. This is exempt under 10 class 1. However, if SOP applies, scheme of partial integration applies, it has to be considered for the scheme of partial integration. Okay. So, where the assessee doesn't stop with curing is roasting it, grounding it, adding chicory or any other flavoring ingredients, then in that case, in the composite business income, 60% is agricultural, exempt under 10(1), 40% is non-agricultural, taxable under the head PGBP. This is regarding disintegration of composite income into agricultural and non-agricultural. Then Chidambaram Pillai Supreme Court judgment, where a partnership firm pays interest and remuneration to the partners. A partnership firm to its partners, it is paying interest or remuneration out of its agricultural income. Out of its agricultural income. The firm, out of its agricultural income, pays interest and remuneration to the partners. Okay, in that case, this interest or remuneration is agricultural income in the hands of partners. This is to be treated as what? Agricultural income in the hands of the partners. One line summary of the entire discussion is, where a partnership firm pays interest or remuneration to its partners out of its agricultural income, then in the hands of partner, that interest and remuneration is also agricultural income. For the partners also, that interest or remuneration is agricultural income. So, salary and interest received by a partner out of agricultural income of the firm is to be regarded as agricultural income in the hands of partner. In the hands of partner, this is exempt under 10(1). However, for computing the tax on non-agricultural income of the partner, okay, we will be using scheme of partial integration. There, this interest and remuneration, which is regarded as agricultural income, will be considered. Consolidation, where a partnership firm pays interest or remuneration to its partners out of its agricultural income. For the partners, that interest and remuneration is what? Agricultural income. It is exempt in the hands of partners under 10(1), but it will be considered for the scheme of partial integration, which is deployed for computing tax on non-agricultural income of the partners. This is R.M. Chidambaram Pillai Supreme Court judgment. Next is, see this example. There is firm. The firm is growing and manufacturing tea in India. The firm is what? Growing and manufacturing tea in India. That means it's carrying on a composite business activity, generating composite income, business income. As per Rule 8, there are two elements here, agricultural element, non-agricultural element. Non-agricultural element is taxed in the hands of the firm under the head PGBP. Agricultural element is exempt in the hands of the firm under 10(1). Under which section? 10(1). But in the hands of the firm, scheme of partial integration will not apply. Firm scheme of partial integration will not apply. So these are all secondary. That is not main discussion. This firm, out of its composite income, it pays interest and remuneration to the partners. The firm, out of its composite income, pays interest and remuneration to the partners. In this interest or remuneration also there are two elements, 60% agricultural, 40% non-agricultural. This 40% is taxable in the hands of partners under the head PGBP. This 60% is exempt in the hands of partners under 10(1) because that is agricultural income. However, this may be considered for the scheme of partial integration for computing the tax on non-agricultural income in the hands of the partners. So, to consolidate the discussion, where a firm is carrying on a composite business of growing and manufacturing tea in India, and out of its composite business income, if it is paying interest and remuneration to the partners, in that interest or remuneration also there are two elements, 60% agricultural, 40% non-agricultural. 60 is exempt under 10(1), 40 is not exempt, it is taxable under the head PGBP in the hands of partners. And the scheme of partial integration, okay, for that we will use this agricultural element for computing the tax on non-agricultural income in the hands of the partners. Only simple. In the interest or remuneration also the same two elements are present, 60-40, 60 is exempt, 40 is taxable. The agricultural element is considered for the scheme of partial integration. That's all. Next is, where a company is carrying on agricultural activity, out of agricultural activity it has generated agricultural income, that agricultural income is exempt in the hands of the company under 10(1). And company, hence it will not be considered for scheme of partial integration. In a scheme of partial integration, will not apply to companies. So there is a company. This company is engaged in carrying on agriculture, generates agricultural income, so where the company out of its agricultural income declares dividend to the shareholder. Before that, this agricultural income is exempt in the hands of the company. This is exempt under 10(1). And for the company, for computing its tax on non-agricultural income, scheme of partial integration doesn't apply because it's company. This is secondary. Come to the main discussion, where the company pays dividend to the shareholders out of its agricultural income. This dividend in the hands of shareholder is not agricultural income, it is only non-agricultural income. The dividend in the hands of the shareholder is only non-agricultural income, even though it is paid by the company out of its agricultural income. Even though the company has paid this dividend only out of its agricultural income to the shareholder, for the shareholder this dividend is what? This dividend is non-agricultural income. This dividend is what? Non-agricultural income. This dividend is non-agricultural income. That you need to note. Why? Because the proximate source for this dividend is not agricultural activity. When the company carries out agriculture, it doesn't mean the shareholders are carrying on agriculture. The proximate source for the dividend is the investment in shares, not the agricultural activity. Company is distinct and separate from the shareholders. So, the proximate source for this dividend in the hands of the shareholder is investment in shares, not agriculture. Therefore, the dividend earned by the shareholder from the company is non-agricultural income, even though the company has paid it out of agricultural income. This is Kumaraswamy versus ITO Madras High Court, Tata Tea and others, Supreme Court judgment. Next is where the assessee is having a nursery where the saplings or seedlings are grown. and those saplings and seedlings are sold. From that, if any income is derived, that is agricultural income. That is agricultural income. The saplings or seedlings, okay, they are cultivated in the agricultural field. From there, they are taken to the nursery, and the nursery owner sells it. So the nursery owner does not carry out the basic operations, okay, for the saplings or seedlings to sprout. The basic operations are carried out in the agricultural field by the farmer. The nursery owner simply purchases them, okay, and grows them and sells it. Even then, even though the basic operations are not carried out by the nursery owner is only carrying out secondary operations, still the income derived from sale of saplings and seedlings is to be treated as agricultural income. So in examination, in the case study or in any problem, income from sale of saplings or seedlings grown in nursery like this, it is given. Close your eyes and decide. It is only agricultural income. It is exempt under 10 class 1. Okay, whether or not the basic operations are carried out by the nursery owner. Next is indirect connection with the land will not make the income agricultural income. For example, okay, Mr. X is owning an agricultural field where he is carrying on agricultural operations, but during the year he has earned rupees 3 lakhs on account of allowing his agricultural field to be used for cinema shooting. So the income which he has earned from, okay, the shooting of films in his agricultural field is not agricultural income. Indirect connection with agricultural land is not enough. Income from allowing cinema shooting in the agricultural field where we carry out agricultural operations is not agricultural income. Indirect connection with agricultural land is not enough. Similarly, income from breeding of livestock, income from poultry farming, income from fisheries, income from dairy farming, okay, etc., is also not to be treated as agricultural income because the connection with the land is indirect. So these are all the aspects you need to know regarding scheme of partial integration. So that also we discussed. In basic concepts, we are left with only 3 sections. One is 115 BA, 115 BAA, and 115 BAB. 115 BAB. We will discuss them. When we were discussing the tax rates applicable for domestic companies, I was classifying domestic companies this way. Domestic company which has exercised the option under 115 BA. Domestic company which has exercised the option under 115 BAA. Domestic company which has exercised the option under 115 BAB. Domestic companies which have not exercised the option under 115 BA or BAA or BAB and whose total turnover or gross receipts for the year 17-18 doesn't cross 400 crores, crosses 400 crores. Like this I was classifying. I was telling you different tax rates for these categories of companies. Now we will be learning the provisions of 115 BA. Then only we can know what is option under 115 BA. Then we will be discussing provisions of 115 BAA and provisions of 115 BAB. Fine. See, if a domestic company exercises option under 115 BA, then the tax rate applicable for that company is what? 25%. It is 25%. So if a domestic company exercises option under 115 BA, then for that domestic company the tax rate is 25%. But which company is eligible for exercising option under 115 BA? The company should have been set up and registered on or after 1st March 2016. The company should have been set up and registered on or after 1st March 2016. Then the company should not be engaged in any business other than the business of manufacture or production of any article or thing and research in relation to such manufacture or production, or other than distribution of such article or thing manufactured or produced by it. Meaning thereby, the company which wants to exercise option under 115 BA should be engaged only in manufacturing or production of article or thing, or it should be engaged in research in relation to such manufacture or production, or is engaged in the distribution of such article or thing manufactured or produced by it. Other than this, it should not carry any other business. It should be engaged only in the business of manufacture or production of any article or thing and research in relation to manufacture or production or distribution of such article or thing manufactured or produced by it. Apart from this, it shall not carry out any other business. Then such domestic company, if it exercises option under 115 BA, the concessional tax rate of 25% shall apply. Fine. If you exercise option under 115 BA and if you want to enjoy the concessional tax rate of 25%, there are some side effects. Okay, you will not be allowed a deduction under 10A. You will not be getting deduction under 32 subsection 1 class 2A. You will not be getting deduction under 32AD, 33AB, 33ABA, 35 subsection 1 class 2, class 2A, class 3, 35 subsection 2AA, 35 2AB, 35 AD, 35 triple C, 35 CCD. These deductions will not be allowed, Not only that, against the gross total income of the company, no Chapter 6A Part C deduction will be allowed. Chapter 6A Part C na 80 IA to 80 RRB. This is called Chapter 6A Part C. None of these deductions will be allowed. Only one exception is 80 JJAA alone is allowable. Only one section under which deduction is allowed under Chapter 6A Part C is 80 JJAA. So the company cannot claim deduction under 80 IA to 80 RRB. Sorry, this option we are telling, this option should be exercised when? Within what time? To come under 115 BA, the option should be exercised within the due date for filing, the first of its return. For the previous year of incorporation, in the assessment year, relevant assessment year, it will be filing return, first return. The due date will be there. Within that due date, the option should be exercised. Once the option is exercised, okay, it cannot be withdrawn. It is applicable for all the subsequent years. That you need to understand. Okay, to consolidate the entire discussion before we proceed further, if a domestic company exercises option under 115 BA, then it will suffer tax at a concessional rate of 25%. However, the following conditions are to be fulfilled. The company should be one which is set up and registered on or after 1st March 2016. The company should be engaged only in manufacturing or production of any article or thing or any related research, or it should be engaged in distribution of manufacturing, distribution of article or product manufactured by it. Other than this, it shall not be engaged in any other business. Okay, if such company exercises option within the due date for filing first of its return, then for that company the tax rate is, concessional rate is 25%. But what the company will lose by coming under 115 BA is, it will lose deduction under 10 AA 32 subsection 1 class 2A 32 AD 33 AB 33 ABA 35 1 class 2 class 2A class 3 35 2 AA 35 2 AB 35 AD 35 triple C 35 CCD. All these things we will study in PGBP chapter and profit link deduction chapter. Also the company cannot enjoy deduction under chapter 6A part C, that is 80 IA to 80 RRB. Only exception is it can enjoy deduction under 80 JJAA. And the option exercise, once exercised, it cannot be withdrawn. It cannot be withdrawn. But one exception is, if the company at a later stage wants to exercise option under 115 BAA, which I am yet to discuss, then the option which it has exercised under 115 BA can be withdrawn. Fine. This is 115 BA. Fine. Here a very important point, if this company which has exercised option under 115 BA is reporting short-term capital gains referred to in 111A, 25% rate will not apply, 15% rate only will apply. If this company which has exercised option under 115 BA, if it is reporting long-term capital gain covered by 112, it will suffer tax on that long-term capital gain at the rate of 20% or 10%, not at the rate of 25%. If this company which has exercised option under 115 BA is reporting any long-term capital gains covered by 112A, then that long-term capital gain will not suffer tax at 25%, it will suffer tax only at the rate of 10%. If this company is having any casual income, okay, in such case, that casual income will not suffer tax at 25%, it will suffer tax at the rate of 30%. If this domestic company which has exercised option under 115 BA is earning dividend from specified foreign companies, that dividend will not suffer tax at the rate of 25%, it will suffer tax only at the rate of 15%. If this domestic company is having any income from undisclosed sources, that is income referred to in 68, 69, 69A, 69B, 69C, 69D, etc., that income will suffer tax at the rate of 60%, not at the rate of 25%, not at the rate of 25%. If the company, domestic company which has exercised option under 115 BA earns any royalty income from patents developed and registered in India, and it has opted for the tax regime under 115 BBF, then that royalty will not suffer tax at the rate of 25%. It will suffer tax only at the rate of 10%. Similarly, if this domestic company which has exercised option under 115 BA is earning any income from transfer of carbon credits, then it will not suffer tax at the rate of 25% on that income. On that income, it will suffer tax only at the rate of 10%. So what I am trying to tell is, where for specific income, specified tax rates are given in the Income Tax Act, for those incomes only those special rates will apply, and not the general rate of 25%, not the general rate of 25%. That you need to note. Even if the company is exercising option under 115 BA, these incomes included in the total income will suffer tax only at these rates, not at the rate of 25%. With this, our discussion on 115 BA is over. Next is section 115 BAA. 115 BAA. Any domestic company which has exercised option under 115 BAA, which has exercised option under 115 BAA, will suffer tax at a concessional rate of 22%. Will suffer tax at a concessional rate of 22%. Consolidation. If a domestic company exercises option under 115 BAA, that domestic company shall suffer tax at what rate? A concessional rate of 22%. Okay, but this concessional tax regime is available from assessment year 2021 onwards only. It's a new section inserted, okay, by Taxation Laws Amendment Act 2019. So it shall suffer tax at a concessional rate of 22%. But listen to me, the side effect of opting for 115 BAA, by opting for 115 BAA, what the company loses? Company loses deduction under 10 AA. Company loses deduction under 32 subsection 1 class 2A. Company loses deduction under 32 AD. Company loses deduction under 33 AB. Company loses deduction under 33 ABA. Company loses deduction under 35 subsection 1 class 2, class 2A or class 3. Company loses deduction under 35 2AA, 35 2AB and 35 AD, 35 triple C, 35 CCD, and also the company loses deduction under chapter 6A part C, but it can still enjoy deduction under 80 JJAA. It can still deduction under 80 JJAA. Similarly, it can also enjoy deduction under 80 LEA, though it is coming in chapter 6A part C. Chapter 6A part C. To consolidate, a domestic company, if it has opted for the provisions of 115 BAA, then that company will suffer tax at a concessional rate of 22%. But the side effect of this concessional tax rate is what? It will lose deduction under all these sections. Under these sections. Also, chapter 6A part C deduction is not available, but it can still enjoy, okay, deduction under two sections coming under chapter 6A part C. What are the 80 JJAA and 80 LA? 80 JJAA and 80 LA. Not only that, one important point, this domestic company need not be a new company. Even an existing company can opt for 115 BAA. So the company is in existence for so many years in the past. Even those companies can opt for 115 BAA. Right from assessment year 2021, it can exercise option. Okay, what it has to do? It has to exercise option within the due date for filing return of income for the assessment year for which it wants to exercise the option. For example, if it wants to exercise option for assessment year 2021 onwards, if it wants 115 BAA to apply for it, then it has to exercise the option within the due date for filing return for the assessment year 2021. Fine. This company, domestic company, for the assessment year 2021, it has opted for 115 BAA. But in the earlier years, it has not opted for 115 BAA. Then, in the earlier years, the company would have enjoyed a deduction under these sections. As a result of the deduction under these sections, there may be some unabsorbed business loss. Pertaining to earlier years. Okay, such portion of the unabsorbed loss attributable to enjoyment of deduction under these sections in the earlier years, okay, will lapse. It cannot be carried forward to the assessment year for which option is exercised. To visualize, I will give you this way. There is a company A Limited. This company, okay, was incorporated, date of incorporation 1st January 2000. That means the company is in existence since 99 2000. From that year it is existing. But this company exercises option under 115 BAA only for the assessment year 2021. Okay, it has exercise option on 1st September 2020 within the due date. So if the company has come under 115 BAA, for this year deduction under specified sections are not available. Deduction under specified sections are not available for this year. This is the year in which option was exercised. Year of option. Not only that, suppose in the earlier assessment years, company enjoyed deduction under these specified sections. Company enjoyed deduction under these specified sections in the earlier assessment year. As a result, okay, there is unabsorbed loss. Then such unabsorbed loss cannot be carried forward to assessment year 2021. Cannot be carried forward. Such losses lapses. That means, okay, for the earlier years, if the company has enjoyed deduction under these specified sections, as a result, if there is any loss, that loss cannot be carried forward to the assessment year for which the option was exercised. Such losses will lapse. Not the entire unabsorbed losses will lapse. Unabsorbed losses of earlier years to the extent attributable to the deduction under these sections will lapse. They cannot be carried forward to the assessment year for which option was exercised. So, in the year of option also we will not allow deduction under specified sections. In the earlier years, if deduction was enjoyed and as a result if there is any unabsorbed loss, the unabsorbed loss of earlier years to the extent attributable to deduction under these specified sections will also lapse. They cannot be carried forward. Not only that, listen to me. If you see the sections under which deduction is not permissible, one of the section is 32 subsection 1 class 2A. This is additional depreciation. This is what? Additional depreciation. So, where there is unabsorbed depreciation of earlier years, there is unabsorbed depreciation, UAD, unabsorbed depreciation. That unabsorbed depreciation to the extent attributable to additional depreciation, will lapse. Such unabsorbed depreciation can't be carried forward to the year of option. Can't be carried forward to the year of option. That will also lapse. Not only that, listen to me. this A Limited, it has exercised option. It has exercised option. It has exercised option under 115 BAA for assessment year 2021. For the assessment year 2021. This company, I'll give you the flashback. Okay, there was a company X Limited. That company amalgamated with A Limited. X Limited amalgamated with A Limited. A Limited is the amalgamating company. X Limited. A Limited is the amalgamated company. What happens pursuant to amalgamation? Unabsorbed non-speculation business losses of X Limited and unabsorbed depreciation of X Limited both are allowed to be carried forward by A Limited. Both are allowed to be carried forward by A Limited under 72A. Under 72A. This amalgamation took place in the assessment year 1920, earlier year. This amalgamation took place in which year? 1920. So, the unabsorbed non-speculation business loss of X Limited and unabsorbed depreciation of X Limited were allowed to be carried forward by amalgamated company. These are all regarded as losses and depreciation incurred by A Limited, and A Limited is allowed to carry forward. A Limited is allowed to carry forward. But in the assessment year 2021, the company has exercised option under 115 BAA. Okay, now the unabsorbed non-speculation business loss of X Limited to the extent attributable to deduction under specified sections. You all know the list. This cannot be carried forward by A Limited. These losses will lapse. Similarly, the unabsorbed depreciation of X Limited to the extent attributable to additional depreciation. To the extent attributable to additional depreciation. To the extent attributable to additional depreciation also cannot be carried forward. They will also lapse. So, one line summary of the entire discussion: where a company exercises option under 115 BAA, okay, for the year of option, the deduction under specified sections will not be available. Not only that, okay, if this company in the earlier year, okay, was with this company in the earlier year, if some other company has amalgamated and that company is the amalgamating company is unabsorbed non-speculation business loss to the extent attributable to the deduction enjoyed under specified sections by that amalgamating company and unabsorbed depreciation to the extent attributable to additional depreciation enjoyed by that amalgamating company, okay, cannot be carried forward and set off by this A Limited which has exercise option, and such losses and depreciation will lapse. That you need to note. So this is given here. Not only that, the unabsorbed depreciation of earlier years to the extent attributable to additional depreciation, I told it will lapse na. Here also I told to the extent attributable to additional depreciation will lapse, but it should be added to the WDV of the block. It should be added to the WDV of the block. So it will lapse, correct, but it will boost the block value. It will boost the block value. It will be added to the block value. That you need to understand. Next is, I told you the option should be exercised within the due date for filing return. For which year you want option, for that year, option should be exercised within the due date. And then once the option is exercised, it will apply for all the subsequent years. You need not exercise option each year. It is automatically applicable for other years. And then for this company, the surcharge rate is maximum 10%. Maximum is flat rate of 10%. Surcharge is 10%. And for this company, MAT provision shall not apply. 115 JB will not apply. For this company, MAT credit will lapse if it is having any MAT credit of the earlier years, that will lapse. 115 JAA MAT credit will lapse. So these are all the points you need to keep in mind in 115 BA. So let me consolidate BAA. Let me consolidate 115 BAA. Listen to me. Any company which exercise option, any domestic company which exercise option to come under 115 BAA will suffer tax at a concessional rate of 22%. But for that option should be exercised within the, for a particular assessment year, if it wants 115 BAA to apply for the first time, then it has to exercise the option within the due date. And the side effect of enjoying concessional tax rate under 115 BAA is, okay, the company will not get deduction under 10 AA and additional depreciation benefit under 32(1)(2)A, 32AD, 33AB, 33ABA, 35 subsection 1 class 2, class 2A, class 3, 35 2AA, 35 2AB, 35 AD, 33, 35 triple C, 35 CCD, and chapter 6A part C deductions will not be allowed. Not only that, one exception is 80 JJAA and 80 LA both coming under chapter 6A part C, but still this company can enjoy deduction under 80 JJAA and 80 LA. It's an exception. Not only that, if the company is having, okay, unabsorbed losses of earlier years, and such unabsorbed losses to the extent attributable to deduction enjoyed by the company under these specified sections will lapse, cannot be carried forward to the year for which option is exercised. Not only that, unabsorbed depreciation of earlier years, okay, to the extent attributable to additional depreciation, okay, will lapse, cannot be carried forward to the assessment year of option, assessment year for which option was exercised. Not only that, company has exercised option under 115 BAA for assessment year 2021, but in one of the earlier year, okay, with that company, some other company got amalgamated, and the unabsorbed non-speculation business loss of that amalgamating company was allowed to be carried forward by the amalgamated company, that is A Limited, which has exercised option under 115 BAA. Then such unabsorbed non-speculation business loss of the amalgamating company to the extent attributable to deduction enjoyed under these specified sections by the amalgamating company cannot be carried forward by the amalgamated company. They will lapse. They will lapse. That is, this unabsorbed non-speculation business loss of X Limited cannot be carried forward by A Limited, which has exercised option under 115 BAA to the extent it is attributable to deduction under specified sections. Similarly, unabsorbed depreciation of the amalgamating company X Limited to the extent attributable to additional depreciation cannot be carried forward by the A Limited, which has exercised option under 115 BAA. That will lapse. That will lapse. But the unabsorbed depreciation to the extent attributable to additional depreciation, though it lapses, it will be added to the block value. It will be added to the block value as on first day of the previous year. As on the first day of the previous year. Then for this company which has exercised option under 115 BAA, the surcharge rate is 10% flat, it doesn't change. For this company, MAT provisions do not apply. For this company, MAT credit of earlier years will lapse. With this, we are through with section 115 BAA. 115 BAA. Next is $115 BAB. 115 BAB. If a domestic company exercises option under 115 BAB, then it will suffer tax at a concessional rate of 15%. It will enjoy a concessional tax rate of 15%. Where a domestic company exercises option under 115 BAB, it will suffer a tax at a concessional rate of 15%. But option could be exercised only from assessment year 2021 onwards. And this section is also inserted only by Taxation Laws Amendment Act 2019. Sorry. However, I was telling you, do you remember? Okay, even some portion of the income of the company will suffer a tax at 22%, 30%, like this I was telling you. Let me explain them. This company, if its total income includes any income, okay, which is not derived from or which is not incidental to manufacturing of or production of any articular thing, and for which no specific rate is given under this chapter, that is chapter number 12, then it shall suffer tax at the rate of 22%. This chapter means chapter 12. To consolidate, listen to me. Domestic company which has exercised option under 115 BAB, for that the tax rate is 15% only. Concessional tax rate 15%. Adukku exceptions are there. Exception number 1. This company's total income includes any income which is not derived from manufacturing, or such income is not incidental to manufacturing. incidental to manufacturing, and such income, and for such income no special rates, specific rates are prescribed in chapter 12. In chapter 12, then such income, not the entire income, shall suffer tax at the rate of 22%, not 15%, where the total income of the company includes any income which is not derived from manufacturing or which is not incidental to manufacturing, and for such income no specific rates are prescribed in chapter 12. Such income shall suffer tax at the rate of 22%. Okay, now I'll give you two income. It is earning some interest income. This interest income is not derived from manufacture. This interest income is not something incidental to manufacture. For interest income, assume no special rates are given in chapter 12. Then for that, the tax rate is 22%, not 15%. Not 15%. Example number 2. If the total income includes income from transfer of carbon credits, income from transfer of carbon credits, then the tax rate is 10% and not 22%, not 22%. Even though this is not derived from manufacture or incidental to manufacture, okay, this shall suffer a tax only at the rate of 10%, because this is specifically covered in chapter 12. Covered in chapter 12. Example number 3. There is long-term capital gains covered by 112A. This is not derived from manufacture or incidental to manufacture, and for that special rates are given in 112. So 10% is the rate applicable and not 22%. Not 22%. So where the total income of the domestic company which has exercised option under 115 BAB, okay, includes any income which is not derived from manufacture or which is not incidental to manufacture, okay, and for such income no specific rates are prescribed in chapter 12. Such income alone will suffer tax at 22%. Fine. Next is exception number 2. What is exception number 2? Where the total income, I'll tell you. Exception number 2, let me explain. Suppose A Limited has exercised option under 115 BAB. This company is transacting with connected persons. It is transacting with connected persons, related persons. It is transacting with connected persons. The transaction may be of two types. It is purchasing goods or availing services or facilities from the connected persons, or it is selling goods to connected persons, Here, what can happen in these transactions? The price may be manipulated. When it is purchasing, the price paid may be less than fair market value or arm's length price. When it is selling goods, the price charged is more than fair market value or arm's length price. As a result of this transaction, more profits are booked in the hands of A Limited. More profits in the hands of A Limited. Less profits in the hands of connected persons. More profits, less profits. Why, I will tell you. When the price paid for purchasing goods is less than fair market value or arm's length price, expenses booked is less. So the profit more goes up. For connected persons, the sales will become less because the price charged is less. So profit comes down. Where the goods are sold for a price more than fair market value or arm's length price, sales of A Limited goes up, profit goes up. Expenses of connected person goes up, profit comes down. So that means the transaction is arranged between the company which has exercised option under 115 BAB and connected persons in such a fashion that more profits are reported from in the hands of company which has exercised option under 115 BAB and less profits are reported in the hands of connected persons. The transactions are arranged in such a fashion, the price is manipulated in such a fashion, more profits come in the hands of A Limited and less profits are in the hands of connected persons. That means these transactions are dubious attempts for shifting the profits from connected persons to A Limited. Why they make an attempt to shift the profits from connected person to A Limited? Connected persons will suffer tax at a higher rate, whereas this company is suffering tax at the tax rate of 15%. So they are connected persons. Okay, where the profit gets reported, it doesn't matter for them. They are connected to that extent. So what happens? Through these transactions, consciously there is an attempt made for shifting the profits from connected persons who are otherwise going to suffer tax at a higher rate to A Limited, which is going to suffer tax at a lesser rate. So this is happening. So to arrest these transactions, what is given here? Suppose the profits reported by A Limited 8 crores. Adile profits arising out of transaction with strangers, arising out of transaction with strangers 6 crores. Profit arising out of transaction with connected person is 2 crores. Profit arising out of transaction with connected person 2 crores. Idhila arm's length profit, boosted profit. Arm's length profit is 1 crore, boosted profit is 1 crore. See, what is arm's length profit? Had these transactions with connected persons been effected at arm's length price or fair market value, the profit that we would have reported is only 1 crore, but we charged a price more than the fair market value or arm's length price when we dealt with connected persons. As a result, the profit got boosted by 1 crore. This is not actually profit of A Limited. This is profit of connected persons shifted in the hands of A Limited for suffering tax at a reduced rate of 15%. Reduced rate of 15%. This boosted profit is deemed to be income of A Limited. For this boosted profit, the tax rate is not 15%. The tax rate is 30%. For this, the tax rate is what? 30%. That you need to note. So, one line summary of this entire discussion is where the company which has opted for 115 BAB, which is suffering tax at a concessional rate of 15%, has transacted with connected persons, and these transactions were effected at a price which is much more than the fair market value or arm's length price. As a result, profit out of these transactions with connected person is boosted. The boosted profit is deemed to be income of A Limited. That will not suffer tax at 15%. That will suffer tax at what rate? 30%. That will suffer tax at what rate? 30%. This is what given here. Fine. So what we are discussing, generally for a domestic company which has exercised option under 115 BAB, the tax rate is 15%. However, exceptions are there where the total income includes any income which is not derived from manufacture or which is not incidental to manufacture, and for such income no specific rates are prescribed in chapter 12. Such income will suffer tax at the rate of 22% and not 15%. This is to punish the company for reporting income which is not derived from manufacturing or which is not derived from incidental activities. Next is connected party transactions. The boosted profit will suffer tax at the rate of 30%. Then exception number 3. What is exception number 3? Where this company which has exercised option under 115 BAB is reporting any short-term capital gain on account of transfer of a short-term capital asset which is not depreciable, then it shall suffer a tax at the rate of 22%. That is, company which has opted for 115 BAB, if its total income includes any short-term capital gain arising from transfer of a non-depreciable asset, then that part of the total income which represents this short-term capital gain shall suffer tax not at the rate of 15%, but shall suffer tax at the rate of 22%. Shall suffer tax at what rate? 22%. So that you need to note. So thus, this company which has exercised option under 115 BAB predominantly suffers tax at the rate of 15%, but some portion may suffer tax at the rate of 22 or 30%. Fine. Next is, for getting the concessional tax regime under 115 BAB, certain conditions are to be complied with. The company should be set up and registered on or after 1st October 2019. And the manufacturing operations should commence on or before 31st March 2023. Only such company becomes eligible for coming under 115 BAB. Suppose a company is created on 1st December 2019, that is in the year 1920, and for the assessment year 2021, it can exercise the option within the due date. Option is to be exercised within the due date for filing first of its return. But this will become a futuristic condition. The option will be intact in the only when the manufacturing operations are commenced within 31st March 2023. The business should not be one which is formed by splitting up or reconstruction of the existing business. It should not be old wine in the new bottle. And we shall not use second-hand machinery for setting up this business, second-hand plant and machinery. However, there are exceptions. If a machinery is imported from the foreign country, even though it is second-hand, we have no problem. It will be treated as a brand new machinery. That means imported second-hand machinery will not be treated as second-hand machinery. Provided for that machinery, no deduction was allowed under the Income Tax Act in the past. And before we install it in India, it was never used by any other person in India. We are the first person to use it in India. Then next is, using second-hand machinery is unavoidable. To some extent, there may be necessity for using them. So therefore a tolerance band is there. Where second-hand machineries are also used, the aggregate value of second-hand machinery should not cross 20% of investment in the total plant and machinery. Investment in plant and machinery is 100 crores and 20% and 20 crores. So the value of second-hand machinery put together cannot cross 20 crores. This is another restriction. Next is, the manufacturing business should not be carried out in a building which was earlier used as a hotel or convention center, in respect of which deduction under 80 ID was claimed and allowed. And the company should not be engaged in any business other than business of manufacturing or production or incidental research or distribution. It should not be engaged in any activity other than manufacturing or production or incidental research or distribution. And following are not to be treated as business of manufacturing or production. Development of computer software is not manufacturing or production. Mining is not manufacturing or production. Conversion of marble blocks or similar items into slabs is not manufacturing or production. Bottling of gas into cylinder is not manufacturing or production. Printing of books or production of cinematograph film is not manufacturing or production. Or any other business as may be notified by the central government as not manufacturing or production will also be not treated as manufacturing or production. So what are all the conditions to be complied with for enjoying deduction under 80, for enjoying the concessional tax rate under 115 BAB? Number one, the company should be set up and registered on or after 1st October 2019. The manufacturing operations should commence on or before 31st March 2023. The business should not be created by splitting up or reconstruction of business already in existence. And then second-hand plant and machinery should not be used. Adhika rendi relaxation. Imported second-hand plant and machinery can be used, provided for that machine no deduction was allowed under the Income Tax Act, and we are the first person to use that machinery in India. Then the aggregate value of all second-hand plant and machineries put together should not cross 20% of the investment in total plant and machinery. And then you should not use any building which was earlier used as a hotel or convention center, in respect of which deduction was claimed and allowed under 80 ID. And the company should not be engaged in any activity other than manufacturing or production or incidental research or distribution. And following are not to be treated as manufacturing or production. Go through the list. Sorry. Then side effect of enjoying deduction under side effects of enjoying concessional tax rate under 115 BAB. 115 BAB is, you cannot enjoy deduction under 10 AA, 32 subsection 1 class 2A, 32 AD, 33 AB, 33 ABA, 35 subsection 1 class 2, same list, 35 subsection 1 class 2A, class 3, 35 2AA, 35 2AB, 35 AD, 35 CCC, 35 CCD are under chapter 6A part C other than 80 JJA, exactly same. And the loss or unabsorbed depreciation, see with this company X Limited is a company which has opted for 115 BAB for the assessment year 2021. The company is also created only in the previous year 1920. Previous year 1920. This company can't enjoy deduction under specified sections. Can't enjoy deduction under specified sections. That is there. Plus, in the previous year 1920, that is in the year in which the company is created, some other A Limited gets amalgamated with the B Limited. Some other company A Limited gets amalgamated with X Limited. X Limited is the amalgamated company, A Limited is the amalgamating company, is the amalgamating company. This company is having unabsorbed losses and unabsorbed depreciation pertaining to earlier years. Pertaining to earlier years. But listen to me, this unabsorbed depreciation loss, to the extent attributable to deduction under the specified sections, deduction under these specified sections, lapses can't be carried forward by X Limited, can't be carried forward by X Limited. Unabsorbed depreciation, to the extent attributable to additional depreciation, lapses can't be carried forward by X Limited, can't be carried forward by X Limited. To the extent attributable to additional depreciation, lapses, it can't be carried forward. That you need to note. Next is, these are all over. Option should be exercised within the due date for filing return for the first of its, within the due date for filing first of the return. Option exercised can't be withdrawn, It is automatically applicable for subsequent years. Surcharge for this company is 10%. MAT provision shall not apply. These are all given in 115 BAB. Final consolidation, because new area, amendment area, na. Any domestic company which has exercised option under 115 BAB will suffer a tax at a concessional rate of 15%. Will suffer tax at a concessional rate of what? 15%. But option should be exercised under 115 BAB within the due date for filing the first of its return. Option can be exercised from assessment year 2021 onwards. But there are certain income of this company which suffers tax, okay, not at 15% but at a higher rate. where the total income includes any income which is not derived from manufacturing or which is not incidental to manufacture and for which no specific rates are prescribed in chapter 12, such income shall suffer tax at the rate of 22%. Then where the company which has opted for 115 BAB deals with transacts with connected persons, and in those transactions there are boosted profits, that is profits which are excessive or unreasonable having regard to the fair market value or arm's length price of the goods transacted, then on that boosted profit is deemed to be the income of the company and it shall suffer tax at the rate of 30%. Then short-term capital gain arising on account of transfer of any short-term capital asset which is not a depreciable asset shall suffer tax at the rate of 22%. Okay, not at the rate of 15%. Then the company should have been, for enjoying the reduction under for enjoying the concessional tax rate under 115 BAB, the company should have been set up on or after 1st October 2019. It should commence manufacturing operations on or before 31st March 2023, and the business should not be one created by splitting up or reconstruction of existing business, and second-hand machinery should not be used. Second-hand imported machinery, no problem. Tolerance limit 20% is there. And then the building which was earlier used as hotel or convention center in respect of which deduction was allowed under 80 ID shall not be used for carrying on the business, and the company should be engaged only in manufacturing or production or incidental research or distribution, not any other business, and these activities are not to be regarded as business of manufacturing or production, and the company shall not enjoy deduction under 10 AA etc. specified sections. And where amalgamation takes place, some other company gets amalgamated with the company which has exercised option at 115 BAB, then the unabsorbed losses to the extent attributable to the deduction under specified sections and unabsorbed depreciation to the extent attributable to the additional depreciation can't be allowed to be carried forward by the company which has exercised option under 115 BAB. It will lapse. And these things you need to note. Option should be exercised within the due date for filing first of the return. For this company, surcharge rate is 10%. MAT provisions will not apply. 115 JB will not apply. This is consolidation. With this, we are through with 115 BAB. So, basic concepts chapter we have covered. What we have learned there? Tax rates applicable for individual HUF, AOP, BOI and AJP. Then next is tax rates applicable for cooperative society, firm, local authority. Next is tax rates applicable for corporate associate. Then surcharge discussion, marginal relief, rebate under 87A, scheme of partial integration, option under 115 BA, BAA and 115 BAB. These provisions we have discussed in basic concepts. Next we enter into important issues in the chapter salaries. Important issues in the chapter salary. There first is ESOP. Pursuant to contract of employment, employee is rendering services to the employer. Employee is rendering services to the employer. For that, the employer is providing remuneration, which includes basic salary, allowances, perquisites, and other elements are there in the remuneration package. One of the perquisite is ESOP. One of the perquisite is ESOP. Employee stock option. Employee stock option. What do we mean by employee stock option? Employee stock option means stock option made available by the employer to the employee. Made available by the employer to the employee. What is stock option? Stock option means a right, not obligation. Right. Right to do what? Right to subscribe to specified number of shares or securities at a specified price. We call it a strike price at a future date upon fulfillment of stipulated conditions, and these conditions are called vesting conditions. So what is called employee stock option? It's a stock option made available by the employer to the employee. Basically, what is stock option? Right to do what? Subscribe to what? The specified number of shares or securities at what price? A specified price on a future date. Okay, when upon fulfillment of stipulated conditions, which we call it as vesting conditions, performance conditions, service conditions. Like the price that we are supposed to pay for getting the shares or securities, okay, is called strike price. The strike price will be usually much less than the fair market value. Then only it will be an advantage to the employee. It will be an advantage to the employee. Fine. In ESOP, there are different events: granting, vesting, exercise, allotment. Granting means we are making available the options to the employee. This is granting. But the moment we make it available to the employees, the options cannot be exercised. Employees, they need to fulfill certain conditions called vesting conditions, which we call as performance conditions or service conditions. If these conditions are fulfilled, okay, the right to exercise option gets vested on them. The right to exercise option gets vested on them. They can exercise the option, they get the right to exercise. This is called vesting. What is called exercise? When they actually exercise by subscribing to the shares, this is called exercise. What is called allotment? When they exercise the option and subscribe for the shares, a company is allotting them the shares or securities. That is called allotment. Thus, there are 4 events. What are they? Granting, vesting, exercise, allotment. Fine. Now, in this background, let us enter into the subject. Section 17 class 2 defines the term perquisite. What the term perquisite is defined where? In 17 class 2. One of the perquisite is employee stock options. 17 class 2 subclass 6 says perquisite includes value of securities allotted directly or indirectly by the employer or former employer, okay, to the employee, either free of cost or at a concessional rate. Perquisite includes what? Value of securities allotted by the employer or former employer to the employee, either free of cost or at a concessional rate, and the allotment may be direct or indirect. In this case, how do we quantify the perquisite? First, ascertain the fair market value of the share or securities on the date of exercise of option. On what date? On the date of exercise of option. Fair market value on the date of exercise of option. Not on the date of granting, not on the date of vesting, not on the date of allotment. Fair market value on the date of exercise of option. Minus the strike price, the amount paid by the employee to get the shares or securities. That is called strike price. The difference is the benefit. That should be multiplied by number of shares or securities allotted. Then we will get the value of perquisite. So first step in ascertain the fair market value of the shares or securities on the date of exercise of option, minus the strike price, that is the price paid by the employee to the employer for getting the shares or securities allotted. The difference is the benefit into number of shares or securities allotted will give you the value of perquisites. This perquisite should be charged to tax in which year? In the year of allotment. In the year of allotment. For deciding the year of chargeability, allotment is important. For deciding the quantum of perquisite, fair market value on the rate of exercise is important. See this illustration. Mr. C is the employee. The option was exercised on 15th March 2019. That is in which year? 1819. The shares were allotted on what date? 5th April 2019. 5th April 2019. In which year allotment takes place? 1920. So, the year of chargeability of perquisite is 1920. Year of allotment. How many shares are allotted? 1 lakh. Fair market value on the rate of exercise is what? 200 per share. Fair market value on the rate of allotment is what? 300 per share. Strike price is what? 10. How do we quantify the perquisite? Fair market value on the rate of exercise, not allotment, 300, 200. Minus what is the strike price? 10. 190 is the benefit for 1 share. Into how many shares are allotted? 1 lakh. That much is the value of perquisite. But it will be taxed in the year 1920, year of allotment. So this you need to note. So we have discussed the meaning of employee stock option. The notes and lecture are going hand in hand with each other. The notes are very much compatible with our lectures. What I discussed is only included here. And if you are very attentive in the classroom, if you go through my material, it will go just like this. Then we have learned meaning of the term perquisite under 1726, year of chargeability, quantum of perquisite, etc. Next is, for quantifying the perquisite, the first step is what? Fair market value on the date of exercise of option, fair market value. We need to know the manner of determination of fair market value. Securities allotted under ESOP, equity shares, other than equity shares. What are the security allotted under ESOP may be equity shares, maybe others, maybe other than equity shares. Where the securities allotted under ESOP is equity shares, fair market value shall be determined in accordance with Rule 3 sub Rule 8. Rule 3 sub Rule 8. Where the securities allotted under ESOP is not equity shares, other than equity shares, the fair market value should be determined in accordance with Rule 3 sub Rule 9. Rule 3 sub Rule 9. So, securities allotted under ESOP is equity shares. Which rule will apply for determination of fair market value? Rule 3 sub Rule 8. Where the securities allotted under ESOP is other than equity shares, for determination of fair market value, which rule will apply? Rule 3 sub Rule 9. Rule 3 sub Rule 9. Fine. Now, let us discuss the manner of determination of fair market value of equity shares. Manner of determination of fair market value of what? Equity shares. For that we need to come to Rule 3 sub Rule 8. We come to what? Rule 3 sub Rule 8. Equity shares are divided into 2 categories: listed, unlisted. For the moment ignore unlisted, we will come to that subsequently. Listed equity shares are divided into 2. Listed in one stock exchange, listed in more than one stock exchange. Now for the moment forget listed in more than one stock exchange. Securities allotted under ESOP is equity shares, that too listed in only one stock exchange. There are 2 scenarios. On the date of exercise of option, these shares are traded in the stock exchange. Then the fair market value is opening sell price prevalent on the date of exercise of option plus closing sell price prevalent on the date of exercise of option, the total divided by 2. Average of opening sell price and closing sell price prevalent on the date of exercise of option. Where equity shares listed in only one stock exchange, but on the date of exercise of option it was not traded. Every listed share need not be traded every day. It is not traded. Then leave the date of exercise of option. Go to the closest date immediately preceding the date of exercise of option. Leave the date of exercise of option. Okay, go to the immediately preceding date on which the shares were traded. Leave the date of exercise of option. Go to the closest date immediately preceding the date of exercise of option on which the shares were traded. On that date, what is the closing sell price in the stock exchange? That should be the fair market value. Where the securities allotted under ESOP is equity shares listed, but listed in more than one stock exchange. In that case, listen to me, on the date of exercise of option, the equity shares are traded, in the stock exchanges. Then suppose it is traded in 3 recognized stock exchanges. Then ascertain the volume of trade in respect of these shares. Ascertain the volume of trade in respect of these shares from each of these stock exchange on the date of exercise of option. Select that stock exchange where the volume of trade on the date of exercise of option is the highest. From that stock exchange on the date of exercise of option, obtain the closing sell price, obtain the opening sell price, find the average. That is the fair market value. Securities allotted under ESOP, equity shares listed in more than one stock exchange, but on the date of exercise of option, these shares were not at all traded in any of the stock exchange. It was not traded in any of the stock exchange. Then leave the date of exercise of option. Go to the closest date immediately preceding the date of exercise of option on which these shares were traded in the stock exchange. These shares were traded on the stock exchange. On that closest date, ascertain the volume of trade in respect of these shares from each of the stock exchange in which it is traded. Suppose it is traded in 3 stock exchange. Ascertain the volume of trade in respect of these shares on the closest date in each of these 3 stock exchanges. Select that stock exchange where the volume of trade is highest. From that stock exchange, on that closest date, what is the closing sell price? That is to be taken as the fair market value. Unlisted equity shares, we need not worry and squeeze our brain. Fair market value is to be determined by merchant banker category 1 registered with SEBI. As on the date of exercise of option, what is the fair market value? You should determine. But listen to me, friends. Where the merchant banker category 1 registered with SEBI has already determined the fair market value of these shares on a particular date which doesn't precede the date of exercise of option by more than 180 days. Then on the date of exercise of option, once again fair market value need not be determined by the merchant banker. The fair market value determined on the earlier occasion itself can be adapted, because in 180 days, 6 months time, fair market value of the shares will not drastically change. This is what given in rule 3 sub rule 8. So let us consolidate the discussion again before we proceed further. Securities allotted under ESOP. Equity shares. And these shares are listed. And they are listed in only one stock exchange. And on the date of exercise of option, the shares are traded. Then ascertain the opening sell price and closing sell price on the date of exercise of option. Find the average, that is the fair market value. Securities allotted under ESOP equity shares listed listed in only one stock exchange, but on the date of exercise of option, these shares are not traded. Leave the date of exercise of option, go to the closest date, immediately preceding the date of exercise of option in which the shares were traded. Okay, from that on that closest date, okay, what is the closing sell price in the stock exchange you ascertain? That is a fair market value. That is a fair market value. Securities allotted under ESOP, equity shares listed and listed in more than one recognized stock exchange. More than one recognized stock exchange. Then the shares were traded on the date of exercise of option. Then ascertain the volume of trade in respect of these shares in each of the stock exchanges where it is traded. Select that stock exchange where the volume of trade is highest. From that stock exchange, on the date of exercise of option, you ascertain the closing sell price, opening sell price, find the average. That is the fair market value. Sorry. Securities allotted under ESOP, equity shares, and these shares are listed in more than one stock exchange, but on the date of exercise of option, these shares were not at all traded in any of the stock exchanges. Then leave the date of exercise of option, go to the closest date, immediately preceding the date of exercise of option, okay, in which the shares were traded in the stock exchange. The shares were traded in the stock exchange. On that closest date, ascertain the volume of trade in respect of these shares in those stock exchanges where the shares were traded. Select that stock exchange where the volume of trade is highest. From that stock exchange, on that closest date, you ascertain the closing sell price. That is a fair market value. That is a fair market value. If the shares are unlisted, equity shares are unlisted, don't squeeze your brain. Approach merchant banker category 1. Ask him to determine the fair market value on the date of exercise of option. But where the fair market value of those shares were already determined by merchant banker category 1 registered with SEBI on a particular date, which doesn't precede the date of exercise of option by more than 180 days, the gap is not more than 180 days, it is only less, then on the date of exercise of option, fair market value need not be determined by merchant banker category 1 registered with SEBI. The fair market value already estimated on the earlier occasion, that itself can be adopted for computing the perquisite, where the securities allotted under ESOP are not equity shares. Then the approach merchant banker category 1 to determine fair market value as on the date of exercise of option, where the securities allotted under ESOP is not equity shares other than equity shares. That is listed or unlisted. You approach merchant banker category 1 registered with SEBI. Ask him to determine the fair market value as on the date of exercise of option. With this, we are through with ESOP. Next is Keyman insurance policy. Keyman insurance policy. You should know, first of all, what is Keyman insurance policy. Businessman pays premium to the insurance company to effect an insurance on the life of Keyman. Businessman pays premium to the insurance company for what? To effect what? An insurance on what? Life of whom? Keyman. So this is called Keyman insurance policy. Businessman pays premium to the insurance company to effect an insurance on the life of Keyman. Why should businessman pay premium to the insurance company to effect an insurance on the life of Keyman? Before that, who is Keyman? Keyman means anybody crucial for your business is Keyman. You are a businessman. For your business, somebody is crucial. Now that man is Keyman. That means he can be a partner, he can be an employee, he can be an agent, or he could be even any other resource person. For a coaching center, faculty is Keyman, because revenue is generated only by the efforts of faculty. So here, where businessman pays premium to the insurance company to effect an insurance on the life of Keyman, the policy is called Keyman insurance policy. Why at all Keyman insurance policies are taken? To protect the business against financial losses caused due to untimely death of Keyman. So if the Keyman dies, the businessman will get crippled. Okay, there may be severe financial loss. Okay, to take care of such situation, to get some cushion in such contingency, Keyman insurance policy is taken. So businessman pays premium to the insurance company to effect an insurance on the life of Keyman to protect the business against financial losses, okay, which may arise on account of untimely premature death of the Keyman. Sorry. Here we need to know the tax implications in the hands of three persons: businessman, Keyman, and insurance company. Tax implications we should know in the hands of three: businessman, Keyman, and insurance company. Sorry. First let us take businessman. Businessman pays Keyman insurance policy premium to the insurance company. This is an expense incurred to protect his business interest. So it is wholly and exclusively incurred for the purpose of his business. So for this premium, the businessman will get deduction under 37(1). Will get deduction under section 37(1). While computing income under the head PGBP, this is allowed as a deduction. One line summary: Keyman insurance policy premium is a business expenditure. Businessman is eligible for a deduction under 37(1) while computing income under the head PGBP. BN Exports Bombay CBDT Circular 38/2016. Sorry. The businessman may get proceeds under Keyman insurance policy from the insurance company under three occasions. Only when businessman surrenders the policy, he may get surrender value, or the Keyman dies, the insured event happens, then from the insurance company the businessman will get proceeds, or the policy matures, then also from the insurance company the businessman gets Keyman insurance policy proceeds. So on three occasions: upon surrender, upon death of Keyman, upon maturity of the policy, okay, the businessman gets Keyman insurance policy proceeds from the insurance company. This Keyman insurance policy proceeds are to be treated as income, where it is given section 2, class 24, subclass 11, it is to be treated as income, for which exemption is not available under 1010D. Exemption is not available under 1010D. And in the hands of businessman, this amount is taxable under the head PGBP, where it is given 28 class 6. This is taxable under the head PGBP. And the insurance company is having TDS obligation. Insurance company is having TDS obligation under which section? 194DA. When there is TDS obligation, only when the businessman is a resident, and the sum paid is 1 lakh rupees or more. If it is less than 1 lakh, no TDS obligation. And tax should be deducted at source when? At the time of payment. The TDS rate, okay, where the Keyman insurance policy proceeds are payable before 1st September 2019, the TDS rate is 1%. On or after 1st September 2019, the TDS rate is 5%. The TDS rate is 5%. Here 1%, here it is 5%. So the insurance company is having tedious obligation at the time of payment, provided the businessman is a resident and the sum paid is 1 lakh rupees or more. The tedious rate depends upon when the sum is payable. It can be 1% or 5% depending upon the date on which it is payable. Next is tax implications in the hands of Keyman. Tax implications in the hands of Keyman. At times, what can happen? The businessman may assign the Keyman insurance policy in favor of Keyman. Businessman may assign the Keyman insurance policy in favor of Keyman. This may be for a consideration or maybe even free. With or without consideration, there can be assignment of Keyman insurance policy in favor of Keyman. In such case, what happens? When the Keyman surrenders the policy, he may get surrender value. Or when the Keyman dies, his legal heir will get the Keyman insurance policy proceeds. Or the Keyman doesn't surrender, Keyman doesn't die, he is surviving, but policy matures. Then also the Keyman insurance policy proceeds will only come to Keyman. Why? Because the policy is assigned in favor of Keyman. Policy is assigned in favor of Keyman. Now in the hands of Keyman, this amount is income. It is not exempt under 1010D. It is not exempt under 1010D. If the Keyman is an employee, this is profit in lieu of salary. As per 17 class 3 subclass 2, this is taxable under the head salary. But if the Keyman is not an employee, it shall be taxed under the head IFOS, where it is given 56 subsection 2 class 4. And the insurance company is having tedious obligation under 194 DA, everything same, no need to repeat. Where a businessman assigns Keyman insurance policy in favor of Keyman, either for a consideration or otherwise, then the Keyman upon death or upon surrender of the policy or upon maturity may get Keyman insurance policy proceeds from the insurance company on which insurance company is having tedious obligation under 184 DA. And for the Keyman, the amount received is income as per section 2 class 24 subclass 11. It is not exempt under 1010D. This is taxed under the head salary if the Keyman is employee, taxed under the head IFOS if the Keyman is not employee. Then last thing here is, there is one explanation to 1010D. What it says, if a businessman assigns Keyman insurance policy in favor of Keyman, and from the insurance company, if the Keyman gets insurance proceeds, because the policy matures, Keyman gets insurance proceeds. This is not exempt under 1010D. Okay, why this clarification comes, I will tell you. The moment businessman assigns the policy, Keyman insurance policy in favor of Keyman, okay, the parties to the contract now change. Earlier the parties to the contract are the businessman and insurance company. Upon assignment, the parties to the contract are now Keyman and insurance company. Now for Keyman, it is his own policy because he is going to continue. Okay, so this is a policy, though it has been assigned by businessman to him, now since it is assigned in favor of him and he is going to continue the policy, okay, it is his own policy, no longer Keyman insurance policy. So when the policy matures and proceeds are coming from the insurance company, this is not Keyman insurance policy proceeds. Therefore, 1010D exemption can be enjoyed. Like this, you should not think. You should not think. So, a fiction is created. If a businessman assigns Keyman insurance policy in favor of Keyman, and the policy matures, and from the insurance company, Keyman gets insurance proceeds, for that exemption is not available under 1010D, and even after assignment, okay, it continues to be Keyman insurance policy. It continues to be Keyman insurance policy. So that is what given in explanation. One line summary where the Keyman insurance policy is assigned in favor of Keyman and he continues the policy, and upon maturity if he is getting any insurance proceeds, that is very much taxable in his hands. It is not exempt under 1010D. Why? Because even after assignment it continues to be Keyman insurance policy. So accordingly no exemption under 1010D, very much taxable. So this is the second topic which I wanted to cover in salary. Now we are having some case laws, important case laws, selected case laws given in the institute publication. ITC Gurgaon, Assasi Hotel, customers servers or waiters. What happens? Customers for availing services from the hotel, they make payment to the hotel plus they give tips also. And the hotel once in a week it distributes the tips to the servers or waiters who were on duty on those days. So tips coming from the customers are collected by the hotel, distributed to the servers or waiters. Now the controversy is whether the tips is to be taxed in the hands of servers or waiters under the head salary, or it should come under the head IFOS. This is the controversy. The contention of the department is the tips are coming from hotel, servers or waiters or employees. Okay, for them it should be taxed under the head salary. Hotel has not deducted tax at source on these tips under 192. TDS on salary not made. Tips salary on these tips, which is salary, tax should have been deducted at source. Hotel has not deducted. So hotel is assessee in default, like this department started. So the matter went to the Supreme Court whether the tips coming from the hotel to the servers or waiters, is it salary or is it taxable under the head IFOS? If it is taxed under the head IFOS, it is not salary. There is no TDS obligation under 192. You cannot regard hotel as assessee in default. But if it is taxed under the head salary, then the hotel has TDS obligation under 192. It has not discharged it. So hotel will be regarded as assessee in default. This is the center of controversy. What the Supreme Court clarified, na? See, this hotel is only a conduit pipe or a medium. Is only a conduit pipe or a medium for flow of tips from customers to the servers or waiters. It's not a payment made by the hotel. It is not a payment made on behalf of the hotel. It is a payment, gratuitous payment made by the customers to the servers or waiters. Just because it is routed through the employer hotel, it doesn't make tips salary in the hands of server or waiters. The server or waiter does not have any enforceable right over tips. For example, on a particular day there is no tip collection, tips collection. The servers or waiters cannot ask the hotel why you did not collect tips from them. No enforceable right is there for the servers or waiters. It doesn't stem from the contract of employment. It is purely a gratuitous payment made by the customers out of convention to the servers or waiters routed through the hotel. So therefore, this should come under the head IFOS, not under the head salary. Tips collected by hotel employer from the customers and distributed to the waiters does not stem from contract of employment. Waiters have no enforceable right. This represents voluntary gratuitous payments made by the customers to waiters through the conduit pipe of hotel, which collects it in a fiduciary capacity. Therefore, such tips are not taxable in the hands of waiters under the head salary. It is taxable under the head IFOS. Hotel has no TDS obligation. So what we are discussing is important case laws in the chapter issues in salary. Next is Director, Delhi Public School, Punjab and Haryana High Court. There is a provision 17 class 2 subclass 3, 17 class 2 perquisite. There one of the perquisite is given in class 3, where employer provides any benefit or amenity to the employee other than accommodation, either free of cost or at a concessional rate. It is perquisite. So what is given in 17(2)(3)? Where employer provides any benefit or amenity other than accommodation to the employee free of cost or at a concessional rate, that is perquisite. Why we are saying other than accommodation? It is covered in 17(2)(1). Okay. Now this should be read along with Rule 3 Sub-Rule 5. What is given in Rule 3 Sub-Rule 5? Employer is providing educational facility either free of cost or at a concessional rate to the member of employee's household. Employer provides free or concessional educational facility to whom? To the member of employee's household. Where the educational facility is provided in the educational institution owned and maintained by the employer. Employer in an educational institution owned and maintained by him is providing educational facility, okay, either free or at a concessional rate to the member of employee's household. Who are member of employee's household? Spouse, children, their spouse, brothers, sisters, parents, servants, other dependents, member of employee's household. So employer is providing free or concessional educational facility to the member of employee's household in educational institution owned and maintained by him. Then this is a benefit to the employee. Okay. So the taxable value of perquisite in the hands of employee is cost of education in a similar educational institution. Minus amount recovered from the employee. This is taxable in the hands of employee as perquisite. There is a proviso in Rule 3 Sub-Rule 5. What the proviso says, where employer provides free educational facility in an educational institution owned by him to the children of the employee, not all member of employee's household, only to the children of the employee, and it is a free educational facility given, and the cost of education in the similar educational institution per child per month doesn't cross 1,000, then Rule 3 Sub-Rule 5 does not apply. Nothing is taxable as perquisite. So what is given in the proviso to Rule 3 Sub-Rule 5? Employer is providing free, not concessional. free educational facility to whom, not to any member of employees household, only to the children of the employee, where in an educational institution owned by him. And the cost of education in similar institution per child per month doesn't cross 1000. Then rule 3 sub rule 5 will not apply. Nothing is taxable as perquisite. This 1000 is a threshold limit, not basic exemption limit. For example, if the cost of education in a similar educational institution per child per month is 10,000, you cannot say 10,000 minus 1,000. Like this, you cannot treat this 1,000 as a basic exemption limit. If it is 10,000 more than 1,000, rule 3 sub rule 5 will apply. Then cost of education in similar education institution per child per month minus amount recovered from the employee will be suffering tax. Example, I will give you this way. Son of employee studies in the school run by employer. Cost of education in similar educational institution is 5,000 per month. It is what? 5,000 per month. Amount recovered from employee 1,000 per month. Amount recovered from employee 1,000 per month. What we should not do, I will tell you. 5,000 into 12 minus 1,000. Minus 1,000, maybe we will have to make it as 2,000. 2,000 into 12, 24,000. Like this, you should not do the computation. What computation is done? First of all, you should understand. Cost of education in a similar education institution is 5,000 into 12. 1,000 rupees up to that exempt into 12. 2,000 into 12 is the amount recovered from the employee. Deduct. Balance is the taxable value of perquisite. Like this, we should not think. In this case, 5,000 into 12 is the cost of education in similar educational institution minus 2,000 into 12 amount recovered from the employee. Balance is perks. Like this you should do, because rule 3 sub rule 5 will apply. This is not coming in proviso. Proviso will not come. Proviso, when it will come? Only when the cost of education in similar educational institution doesn't cross 1,000. It has crossed 1,000, this rule will not apply. This 1,000 given is the threshold limit, not basic exemption limit. You cannot reduce it. Next is third case, Shankar Krishnan Bombay. You all know 17 class 2 subclass 1. Employer is providing rent-free accommodation to the employee. It's a perquisite to the employee. How do we quantify the perquisite that is given in rule 3 sub rule 1? That is given in rule 3 sub rule 1. If the accommodation was taken by the employer on lease for providing to the employee, then the perquisite is 15% of salary or lease rent paid by the employer, or lease rent paid by the employer, whichever is less. It is 15% of salary or lease rent paid by the employer, whichever is less. Where employer provides rent-free accommodation to the employee, it's perquisite. How do we quantify the perquisite? If the accommodation provided to the employee was taken on lease by the employer, the perquisite in the hands of the employee is 15% of salary or lease rent paid by the employer, whichever is less. Whichever is less. Fine. Now come to the facts. There is a person, Shankar Krishnan. There is a person, Shankar Krishnan, is an employee of X Limited. Employer is X Limited. Employee Shankar Krishnan. The company has given him rent-free accommodation. Company has given him what? Rent-free accommodation. See, this accommodation is not owned by the company, but it has taken on lease from the landlord. LL landlord. The company has taken the accommodation on lease from the landlord. But for getting the accommodation on lease, the company has deposited some amount as security deposit, which is obviously refundable after the lease period. Okay, so at the inception of the lease, for getting the accommodation on lease, the company deposits some security deposit with the landlord. Facts are as under. Employer company is X Limited. It is providing rent-free accommodation to the employee Shankar Krishnan, but that accommodation is not owned by it. It is taken on lease from the landlord. It is taken on lease from the landlord. And for getting the accommodation on lease, it has to pay lease rental every month. But at the inception of the lease, it has paid some amount as security deposit, which is refundable after the lease period. What the assessing officer did while computing the perquisite taxable in the hands of Shankar Krishnan, 15% of salary, okay, should be compared with lease rent paid by the employer. Whichever is less is the perquisite. That is how Shankar Krishnan has computed. 15% of salary, lease rent paid by the employer, whichever is less. Okay, lease rent paid by the employer is less. So that was offered as perquisite by Shankar Krishnan. But what assessing officer did, instead of taking lease rent paid by the employer for comparison with 15% of salary, he took lease rent paid by the employer incremented with notional interest on security deposit and computed fair rent, compare fair rent with 15% of salary. The thinking is what? For occupying this building, not only monthly rent is paid, at the inception some security deposit is given to the landlord. The landlord had opportunity to place the money in fixed deposit, earn some interest. So therefore, that is also added. Notional interest on that deposit is also added to quantify fair rent. So the real consideration for occupying the building is not only the rent which is paid every month. Okay, see, also we gave an opportunity to the landlord for placing the security deposit in fixed deposit with banks for earning interest. So notional interest on such security deposit, okay, is incrementing the lease rent. Lease rent paid by the employer is incremented by notional interest on that security deposit. That means the assessing officer is importing the concept of fair rent into Rule 3, Sub-Rule 1, fair rent, and he is making comparison. Still the lease rent paid by the employer incremented by notional interest on security deposit is less than 15% of salary, that is offered as perquisite, that is taxed as perquisite. Matter was challenged by Shankar Krishnan in the court. Court says this is wrong. Rule says only comparison between 15% of salary and lease rent paid by the employer. There is no authorization in the rule for incrementing the lease rent paid by employer with the notional rent on security deposit. Okay, so therefore this is something alien to the concept, alien to rule 3. Fair rent concept is something alien to rule 3. It cannot be imported. Assessing officer shall not substitute his wisdom for the wisdom of the lawmakers. You should follow rule 3. You should not import new things into rule 3. This is wrong. So we should compare only lease rent paid by the employer without incrementing it with notional interest on security deposit with 15% of salary. This is there. So we have completed important case laws in the topic salary. There are some amendments in salary chapter. The standard deduction against gross salary, standard deduction is allowed na. Earlier it was 40,000, the standard deduction has now become 50,000. This is an amendment brought out by Finance Act 2019. Next is, in the past, medical bill reimbursement by employer is reimbursing medical bill, and that medical bill reimbursement up to 15,000 was not taxable. Like this it was there, na? That is gone. Now the entire medical bill reimbursement is taxable. Entire medical bill reimbursement is taxable, no exemption. Plus transport allowance. Transport allowance is eligible for exemption under section 1014 read with rule 2BB sub rule 2. Read with rule 2BB sub rule 2. But that exemption earlier it was for all employees. Normal employees, blind, deaf, dumb, handicapped. For normal employees, the exemption under 1014 was 1,600 per month for transport allowance. For blind, deaf and dumb, handicapped persons, the exemption under 1014 was 3,200 per month. But for normal persons, exemption is withdrawn under 1014. Exemption under 1014 in respect of transport allowance is now only for employee who is blind, who is deaf and dumb, and who is handicapped, orthopedically handicapped. To consolidate, medical bill reimbursement is now fully taxable. Exemption at 15,000 is not available. Next is transport allowance, for which exemption is provided under 1014 read with rule 2BB. But that exemption is not available to normal employees. It is available only to employees who are blind or who are deaf and dumb and who are orthopedically handicapped. Only for them exemption is available, and the exemption is 3,200 per month. With this, the amendments, recent amendments in salary is also over. So, chapter 2 is over. Chapter number 3, important issues in house property. Important issues in house property. Now we are going to discuss issues in the chapter IFHP. See, there are some amendments brought out by Finance Act 2019 to section 23. If you are occupying your own house for your residential purpose, the annual value is nil. Net annual value is nil. Standard deduction will not be available because it is 30% of net annual value. So 0 to 30% is 0. Only interest on borrowing is to be allowed as a deduction. That interest on borrowing should not cross the ceiling. Should not cross the ceiling. Ceiling we will discuss separately. So from the house property which is self-occupied for residence, either there will be zero income or there could be loss. Loss will be on account of interest on borrowing. If you have borrowed money for purchase or construction or reconstruction or repairs or renewal, then the interest becomes deductible, but the deduction is subject to a ceiling. So it can result in a loss. So this is called self-occupied property benefit. When the annual value is treated as nil, this is called self-occupied property benefit. So where a house property is occupied for own residence, the annual value of that house property is nil. Interest on borrowing is allowed as a deduction subject to a ceiling. Earlier, this self-occupied property benefit was available only in respect of any one house of the choice of the assessee. If the assessee is occupying more than one house for self-occupation for residential purpose, it was possible in the past to enjoy self-occupied property benefit in respect of only one house of the choice of the assessee. Other houses are deemed to be let out. This was the position in the past. Suppose Mr. X is having 3 houses. All are self-occupied for residential purpose. In the past, he could have enjoyed self-occupied property benefit only in respect of one house. The other 2 houses, regarded as deemed to be let out, and we would have computed income. But now the amendment is, we can enjoy self-occupied property benefit in respect of any 2 houses of the choice of the assessee, any 2. For example, if assessee is Mr. C and he is having 3 house properties, house 1, house 2 and house 3, then he can either enjoy self-occupied property benefit in respect of house 1 and house 2, or house 1 and house 3, or house 2 and house 3. He can enjoy self-occupied property benefit in respect of any 2 houses of his choice. Thus, there are 3 options here. Option 1, enjoy self-occupied property benefit for house 1 and house 2. Treat house 3 as deemed to be let out. And option number 2, enjoy self-occupied property benefit in respect of house 1 and house 3. Treat house 2 as deemed to be let out. Or enjoy self-occupied property benefit in respect of house 2 and house 3. Enjoy house 1 as deemed to be let out. Like this, there are 3 options. So we will compute income under the head house property or loss under the head house property in each of these 3 options. Where there is loss, we will select that option where the loss is highest. If there is income, we will select that option where the income is the least. So one line summary, one change here is self-occupied property benefit now can be enjoyed in respect of 2 houses. Earlier it was 1 house. This is what given here. I was telling you, there is ceiling in respect of interest on borrowing. If you are claiming self-occupied property benefit, interest on borrowing is deductible subject to a ceiling. Let us recapitulate the ceiling we have learnt in intermediate. Purpose of borrowing is purchase or construction, repairs or renewal. When you borrow for repairs or renewal, the ceiling in respect of deduction in respect of interest on borrowing is only 30,000. Where you borrow money for purchase or construction, and the date of borrowing is before 1st April 1999, then the ceiling in respect of deduction in respect of interest on borrowing is only 30,000. Where the borrowing is on or after 1st April 1999, the gap between end of the financial year of borrowing and the date of completion of purchase and construction, date of completion of purchase or construction, the gap is not is more than 5 years, then the ceiling in respect of deduction in relation to interest on borrowing is only 30,000. But where the gap between the end of the financial year of borrowing and the date of completion of purchase or construction is not more than 5 years, is not exceeding 5 years, the ceiling in respect of deduction in relation to interest on borrowing is rupees 2 lakhs. But if you want to enjoy this ceiling of 2 lakhs, you need to obtain a certificate from the lender specifying the amount which he has lent and the rate of interest, etc. To consolidate, I was telling you, if you are enjoying self-occupied property benefit in respect of a house, interest on borrowing is deductible but subject to a ceiling. Ceiling depends upon the purpose for which you borrow. If you borrow for repairs or renewal of the house property, the deduction in respect of interest on borrowing is subject to a ceiling of 30,000. Where the purpose of borrowing is purchase or construction and the borrowing is before 1st April 1999, then the deduction in respect of interest on borrowing is subject to a ceiling of 30,000. Where the date of borrowing is on or after 1st April 1999, the gap between the end of the financial year of borrowing and the date of completion of purchase or construction is more than 5 years. The deduction in respect of interest on borrowing is subject to a ceiling of 30,000. Where the gap is not more than 5 years, the deduction in respect of interest on borrowing is subject to a ceiling of rupees 2 lakhs. But if you want to enjoy ceiling of rupees 2 lakhs, certificate from the lender is to be obtained. Sorry. Now you can enjoy self-occupied property benefit in respect of 2 houses, na? Yes. Okay, but the ceiling in respect of interest on borrowing in relation to both the houses, will be either 30,000 or 2 lakhs. It cannot cross 2 lakhs. That means the deduction under 24 class B in respect of all the houses for which you are enjoying self-occupied property benefit cannot cross 2 lakhs, cannot cross 2 lakhs. This is what given here. The total interest cannot cross rupees 2 lakhs. You may enjoy self-occupied property benefit in respect of 2 houses, but the deduction under 24 class B in respect of both the houses cannot cross rupees 2 lakhs. Maximum deduction under 24 class B is only rupees 2 lakhs. Amendment number 2. Assessee is a builder or a flat promoter. In the building constructed, there are so many residential units or commercial units. These are all stock in trade for him, meant to be sold in the ordinary course of business. But not all units are sold in one stroke. Some units may remain unsold for some time period. In such unsold period, until it is sold, why should we keep it vacant? That thinking may come for the builder or flat promoter. He may let out, and if he is earning rental income, that rental income should come to the head IFHP. It should not go to the head PGBP. So where a flat promoter is letting out or a builder is letting out his residential or commercial units which are stock in trade, until they are sold, why should they be kept idle? Let them fetch some rental income. With this intention, it is let out, the rental income shall come to the head IFHP, not to the head PGBP. Sorry. Where the unsold residential units or commercial units are remaining vacant, then the annual value becomes taxable. The annual value becomes taxable. But some relaxation is given for some period under section 23 class 5. What relaxation? For a period of 2 years from the end of the financial year in which completion certificate was obtained. For this building, completion certificate was obtained in a financial year, from the end of that financial year for a period of 2 years. If these are vacant, annual value should be treated as nil. We shall not notionally compute some annual value. Inherent rent earning capacity of the building should not be quantified and taxed. Annual value should be taken as nil. So where the residential or commercial units are remaining unsold and they are also vacant, then the annual value will be taken as nil for a period of 2 years from the end of the financial year in which completion certificate was obtained. But beyond these 2 years, it will not be taken as nil. The inherent rent earning capacity of the residential unit or commercial unit will be ascertained. That will be brought to tax. Earlier it was 1 year, now it has become 2 years. This is the amendment here. Then the third amendment is 80 EEA. 80 EEA. In my material, longly typed as 80 EE. Conditions for availing deduction under 80 EEA. Finance Act 2019 amendment. For enjoying deduction under 80 EEA, assessee should be an individual. You should have taken loan. For either purchase or construction of the residential house property. The loan is taken from bank or a housing finance company, and the loan has been sanctioned during the financial year 1920. The stamp duty value of the property should not cross 45 lakhs. Assessee does not own any residential house property on the date of sanction of loan. If these conditions are satisfied, 80 EEA, which is a section newly inserted in Chapter 6A, allows deduction in respect of interest on such loan, but the entire interest on such loan will not be allowed as a deduction. We will allow only up to 1,50,000 interest payable on the above loan, or 1,50,000, whichever is less, will be allowed as a deduction. So, for enjoying deduction under 80 EEA, what are the conditions? First of all, the assessee should be an individual. Join me. Don't keep mum. And assessee should have taken loan. Spirit recono. This is a revision batch for consolidation. Okay, assessee has taken loan for acquisition, that is purchase or construction of a residential house property. Loan was taken from bank or housing finance company. Loan was sanctioned during the financial year 1920. The stamp duty value of the residential property does not cross 45 lakhs. The assessee does not own any other residential property on the date of sanction of loan. Then under Chapter 6A, under 80 EEA, deduction is available in respect of interest on loan, but maximum deduction under this section could be only 1,50,000. But listen, where for a part of the interest deduction is enjoyed under 24 Class B, then for what deduction was not allowed under 24 Class B, only deduction can be allowed under 80 EEA. The same interest segment will not be entitled to deduction under 24 Class B and 80 EEA. So that means, to the extent not allowed as a deduction under 24 Class B can be taken under 80 EEA, it can be allowed as a deduction subject to ceiling of 1,50,000. For example, if you are purchasing a house property for your own residential purpose, the interest on borrowing can be allowed as a deduction under 24 Class B up to 2 lakhs. Under the head house property, deduction can be enjoyed up to 2 lakhs. Okay, what is not allowed under 24 Class B? The excess interest can be taken to 80 EEA and you can enjoy up to 1,50,000. So what you need to remember, if the property is a let out property, entire interest on borrowing is allowed as a deduction without ceiling. The ceiling is only in respect of a self-occupied property. If it is a let out property, 80 EEA has no relevance. Why? Because under the head house property itself, under 24 Class B, entire interest on borrowing is allowed as a deduction without any restriction, without any ceiling. So 80 EEA is relevant only for enjoying deduction in respect of interest on borrowing which was taken for purchase or construction of a house property which is meant for own residence, So this is 80 EEA. So amendments in IFHP is over. Next is case laws, important case laws given in the institute publication selected by us. Chennai Properties and Investments Limited. See, the facts of the case are as under. The memorandum of association of the company, its main in the objects class, if you see the main object, the company was created only for developing and letting out properties. If you see the memorandum of association, the object class, the main objects and developing and letting out properties. For that only the company was created. Developing and letting out properties. And for the relevant assessment year, the company filed return of income. In the return of income, its only income is rental income. The entire returned income, entire returned income comprises of rent only. Okay. Now the issue before the Supreme Court is whether this rental income should come to the head PGBP or IFHP. The Supreme Court ruled that this should come under the head PGBP. The very business, the very purpose for which company is created is to develop and let out properties. This is done in the ordinary course of business. So the rental income shall not go to the head IFHP, it shall go to the head PGBP. It shall go to the head PGBP. So income from letting out properties by a company whose main object as per its memorandum of association is to acquire and let out properties and whose entire income as per the return was only from letting out properties shall be taxable as its business income. Next judgment, Royal Corporation Private Limited. So in this case, facts are slightly different. The company was earlier carrying on two business activities, business of developing and leasing out properties and other business activities. So if you see the objects class, the company is not created only for the business of developing and leasing out properties, it is also created for other business activities. This is not the sole main object, there are other main objects also. But in the earlier year, the other business activities reported loss. So the company discontinued the other business activities. As of now, in the current year, the only one business activity is the business of developing and leasing out properties. And the substantial income of the company came only from this leasing. So once again the controversy came before the Supreme Court whether this rental income should come to the head PGBP or IFHP. The contention of the department is Chennai property case will not apply because this is not the sole business. This is not the sole main object. In the memorandum of association, there are also other objects for which the company was created. Like this it was argued. So the Supreme Court clarified, so long as the substantial income came only from the rent from these properties and it does not carry out any other business activity, it doesn't matter as to whether this is the sole main object or there are other main objects. So it has to come under the head PGBP, not under the head IFHP, As he had stopped its other business activities and continued only the business of leasing out its properties and earning rent therefrom, held that income from such property, even though in the nature of rent, should be treated as business income. The fact that the company was not created solely for leasing out properties to earn rental income is irrelevant. This need not be the sole object for which the company is created. In Raj Dadarkar and Associates case, the assessee could not prove that the substantial income came from letting out property. That's the reason why Supreme Court held that the rental income should go to the head IFHP. See, there is another case here, Raj Dadarkar and Associates Supreme Court. In that case, what happened? The assessee company was earning rental income by letting out properties. But the assessee could not establish that This rental income is the substantial income. The substantial income came only from the rent, letting out of properties. Like this, it could not be proved. So therefore, okay, but in the earlier two cases, in Chennai Properties and Investment case, Investments Limited case, the only income included in the return was rental income. In Royal Corporation Private Limited case, the substantial income, 95% of the returned income comprises of only rent. That way it could not be established in Raj Dadarkar and Associates. Rental income was there from letting out properties, but the assessee could not produce evidence to establish that substantial income came only from letting out the properties. So therefore, Supreme Court held that it should go to the head IFHP, not PGBP. So we will always see whether the substantial income comes from letting or not, to decide as to whether it should come under the head PGBP or IFHP. Hari Prasad Bhojnagar Wala, Gujarat judgment. All these years we were under the impression that self-occupied property benefit could be enjoyed only by individual. Why? Because only individual can personally occupy the house property for his own residence. Other assessees cannot. This was the thinking in the past. But Gujarat High Court says, even HUF can enjoy self-occupied property benefit. If the assessee is a Hindu undivided family, there is a house property which is occupied by the family members for their own residence, the annual value is nil. Annual value is nil. Self-occupied property benefit could be available even for HUF, not only to individual, because HUF is a group of individuals related to each other, either by blood relationship or marital tie or adoption. Okay, HUF consists only of natural persons, and until partition, the property belongs to all members. They personally reside in the house property. So therefore, it should be understood as HUF has only resided in the house property. Annual value should be treated as nil. Self-occupied property benefit should be given even to HUF. Even to HUF. Next is NDR Warehousing Private Limited Madras judgment. The assessee was a company. If you see the object clause of Memorandum of Association, it says, okay, the company is created for carrying on business of warehousing, handling and transport. Warehousing, handling and transport. It was not just letting out warehouses, but it was providing storage of goods with rendering of auxiliary services, several auxiliary services such as pest control, rodent control, fumigation services to prevent the goods stored from being affected by vagaries of moisture and temperature. Further, securities were deployed for protection of the goods. Okay, and these activities were carried out on an organized basis. So these activities are more than mere letting out of godown for tenancy. So therefore, the income from these operations should go to the head PGBP and not IFHP. In this case, the assessee company was not just exercising its ownership right in a godown building and was simply earning rent. Okay, it was using this building for its warehousing business, handling and transport. So it was not just providing space alone, it was providing storage services, auxiliary services such as pest control, rodent control, fumigation services. Okay, loading, unloading, all services are being provided, and even security were deployed for protection of the goods. So these activities were carried out in an organized manner. This is not just letting out building on a tenancy for earning rent. This is a business carried on. In that the building is being used. So therefore, the entire profit should go to the head PGBP and nothing is traceable to the head IFHP. These are all some important judgments in the topic house property. And the chapter number 4 that we are going to take for discussion is gift. in taxation of gifts, we are going to discuss two provisions. One is section 56 subsection 2 class 10. Another is 56 subsection 2 class 7b. Here there is Finance Act 2019 amendment 56 subsection 2 class 10, 56 subsection 2 class 7b. Fine. Sorry, let us take the first provision for discussion. 56 subsection 2 class 10, and it is having a proviso and it is having an explanation. And in class 10 there are three subclasses A, B, C. And in subclass B there are two items A, B. In subclass C there are two items A, B. So this is the structure of the provision which we are going to discuss. Where this is 56 subsection 2 class 10 subclass A. Where any person receives a sum of money from any other person or persons where any person receives a sum of money from any other person or persons without consideration, without consideration, and the aggregate value of such sum of money received during the previous year, the aggregate value of such sum of money received during the previous year, if it exceeds 50,000, then the whole of the aggregate value of such sum of money, is taxable in the hands of the recipient under the head IFOS. The previous year of chargeability is previous year of receipt. To consolidate, where any person receives a sum of money during the relevant previous year from any other person or persons without consideration, the aggregate value of such sum of money received during the previous year, if it is crossing 50 lakhs, then 50,000, then the whole of the aggregate value of such sum of money, is taxable in the hands of the recipient under the head IFOS in the year of receipt. This is what given here. Where any person receives during the previous year any sum of money without consideration from any other person or persons, and the aggregate of such sum of money exceeds 50,000, okay, then the whole of such sum, okay, this 50,000 is threshold limit and not basic exemption limit. The whole of such sum of money should be brought to tax under the head IFOS in the year of receipt, in the previous year of receipt. This is what given in 56 subsection 2 class 10 subclass A. However, at the same time, you need to link it with section 9, subsection 1, class 8. This is Finance Act 2019 amendment. Finance Act 2019 amendment. Where a foreign company or a non-corporate non-resident, where a foreign company or a non-corporate non-resident receives any sum of money without consideration outside India from a resident, and the date of receipt is on or after 5th July 2019, on or after 5th July 2019, section 9 subsection 1 class 8 says, section 9 subsection 1 class 8 says, for the foreign company or non-corporate non-resident, this is deemed to accrue or arise in India. It is an Indian income. It is an Indian income. Okay, to consolidate, see this. Section 9, subsection 1, class 8. Foreign company or a non-corporate non-resident receives a sum of money without consideration where outside India from a resident, and the date of receipt is on or after 5th July 2019, on or after 5th July 2019, this sum of money for the recipient, who is the recipient, foreign company or non-corporate non-resident, is deemed to accrue or arise in India, deemed to accrue or arise in India, where it is given 918, is deemed to accrue or arise in India. It is an Indian income for the foreign company or non-corporate non-resident. Okay, it is taxable subject to 56 subsection 2 class 10. Suppose if the money is less than 50,000, then it may not be taxable, because 56(2)(10) talks about taxing it only when the aggregate value crosses 50,000. So, one line summary, where a foreign company or a non-corporate non-resident receives a sum of money without consideration from a resident outside India, okay, and the date of receipt is on or after 5th July 2019, the sum received is income deemed to accrue or arise in India for the foreign company or non-corporate non-resident. It is Indian income. It is taxable under the head IFOS, subject to 56(2)(10), subject to 56(2)(10). That you need to note. This is what given here in the note. Next is section 56, subsection 2, class 10, subclass B, item A. Next 56, subsection 2, class 10, subclass B, item A. Where any person receives during the relevant previous year from any other person or persons an immovable property being a capital asset, without consideration, and the stamp duty value of such immovable property is more than 50,000, then that stamp duty value is taxed under the head IFOS in the hands of recipient in the previous year of receipt. So what is given in 56 subsection 2 class 10 subclass B item A? Where any person receives during the relevant previous year from any other person or persons any immovable property being a capital asset, without consideration, the stamp duty value of which is more than 50,000, then the stamp duty value should be brought to tax in the hands of the recipient under the head IFOS in the year of receipt. What is the significance of immovable property being a capital asset? Suppose if this person is giving a rural agricultural land to him, rural agricultural land immovable property, but it is not a capital asset, even though the stamp duty value may be more than 50,000, nothing will be taxed, because this 56(2)(10)(ba) will apply only when there is gift of immovable property being a capital asset, rural agricultural land given as a gift, nothing is taxable because it is not at all a capital asset. Next is, come to this case, Mr. C is getting a non-agricultural land as a gift from friend 1, the stamp duty value which is 40,000. Friend 2 he is getting house property as gift, the stamp duty value of which is 45,000. Listen to me, the stamp duty value of this immovable property is less than 50. Stamp duty value of this immovable property is also less than 50. But the stamp duty value of these two immovable properties received as a gift put together 40 plus 45, 85. 85 is more than 50. Are you all listening? But here 56(2)(10)(ba) will not apply. 50,000 is the threshold limit for each property received. Why? Because in 56(2)(10)(a) the wording is the aggregate value of all such sum received during the year crosses 50,000. That's why we aggregated all monetary gifts compared with 50. But here the language employed is where the stamp duty value of the property is more than 50. That's how. So the threshold limit of 50 is not for all the immovable properties received by way of gift. It is for each immovable property. So here it is not crossing 50. Here it is not crossing 45. So not crossing 50. So 56 subsection 2 class 10 subclass B item A will not apply. Nothing is taxable under the head IFOS. See this, you will understand. Where any person receives during the previous year any immovable property being a capital asset without consideration from any other person, the stamp duty value of which, that's all. There is no reference to aggregate. Here the wording is the aggregate of such sum. Here abdilla. The stamp duty value of which exceeds 50,000, then the stamp duty value shall be charged to tax. So this is the threshold limit for each property. Next is 56 subsection 2 class 10 subclass B item B. You need not remember all these things. If you remember the content, that is sufficient. Where any person receives during the relevant previous year any immovable property being a capital asset, for a consideration is paid for a consideration which is less than the stamp duty value, and the difference between stamp duty value and consideration is more than 50,000 and cumulative, and the stamp duty value minus consideration is greater than 5% of consideration, then the difference between stamp duty value and consideration shall be charged to tax under the head IFOS in the year of receipt. So see this again. Where any person receives during the relevant previous year from any other person immovable property being a capital asset for a consideration, it is not gift, for a consideration but that consideration is less than the stamp duty value. That consideration is less than the stamp duty value. And not only that, the difference between stamp duty value and consideration is more than 50,000, and it is also more than 5% of the consideration. Then the difference between stamp duty value and consideration should be brought to tax in the hands of the recipient under the head IFOS in the year of receipt. In the year of receipt. Read this. Where any person receives during the previous year any immovable property being a capital asset for a consideration which is less than the stamp duty value, and the stamp duty value minus consideration is more than 5% of consideration and more than 50,000, then the difference between stamp duty value and consideration shall be charged to tax under the head IFOS in the year of receipt. In the year of receipt. This you need to note. Here there is one important point I want to share. Assess is X. From Y, he purchases a plot. He purchases a plot. Y is seller, X is buyer. The agreement was there between parties. The date of agreement is 1st August 2019. Date of registration is 1st October 2019. There is a time gap. Consideration agreed between the parties 100 lakhs. Consideration agreed. Stamp duty value on the date of registration, agreement was 80 lakhs. Stamp duty value on the date of registration 120 lakhs. These are all the facts. Consideration agreed over 100 lakhs. Date of agreement is 1st August. Date of registration 1st October. Stamp duty value on the date of agreement 80 lakhs. Stamp duty value on the date of registration is 120. Now we are having a doubt. If you take stamp duty value on the date of agreement and compare it with consideration, if you do the comparison between stamp duty value on the date of agreement with consideration, if you do the comparison, the consideration is more than the stamp duty value on the date of agreement. So there is no chance of invoking 56(2)(10) BB. That means immovable property is purchased for a consideration is less than stamp duty value, and the difference between stamp duty value and consideration is more than 50,000, more than 5% of blah blah, that thing will apply. Why not? Consideration itself is more than the stamp duty value. So only when the stamp duty value is more than the consideration, we can think of invoking this provision. Nothing is taxable under the head IFOS. To the contrary, when we take stamp duty value on the date of registration and compare that with consideration, what happens? The stamp duty value on the date of registration is 120. It is more than consideration. And the difference between stamp duty value and consideration is more than 50,000. And the difference between stamp duty value and consideration is more than 5% of consideration. Okay, so the requirements are satisfied. The stamp duty value minus consideration, how much? 20 lakhs. 20 lakhs is more than 50,000. 20 lakhs is more than 5% of consideration, 5 lakhs. So all the requirements are satisfied. 56 to 10B will come, and stamp duty value 120 lakhs minus consideration 100 lakhs, 20 lakhs will be taxed under the head IFOS. So it all depends on the stamp duty value which we are taking. Okay, if you take stamp duty value on the date of agreement, nothing is taxed under the head IFOS. If you take stamp duty value on the date of registration for comparison, 20 lakhs will get taxed under the head IFOS. Which stamp duty value should be taken? Which stamp duty value should be taken? Should we take the stamp duty value on the date of agreement, or should we take stamp duty value on the date of registration? For that only answer is given here. Read this. If the stamp duty value on the date of agreement is different from the stamp duty value on the date of registration, the stamp duty value on the date of registration shall be considered by default. However, where the amount of consideration or part thereof has been paid by way of account pay check or account pay bank draft, or by use of electronic clearing system through bank account, or by any other electronic mode, as may be prescribed, and the payment is made on or before the date of agreement, then the stamp duty value on the date of agreement is to be taken. Stamp duty value on the date of agreement is to be taken. See, I will tell you, by default, stamp duty value on the date of registration is to be taken. However, stamp duty value on the date of agreement can be taken. Agreement can be taken if the following condition is satisfied. If the following condition is satisfied. What condition? On or before the date of agreement. The whole or part of the consideration. Is paid on or before the date of agreement. The whole or part of the consideration is paid by way of account payee check or account payee bank draft, or by use of electronic clearing system, or by any other electronic mode prescribed. any other electronic mode as may be prescribed, then we can take stamp duty value on the date of agreement on or before the date of agreement if the whole or part of the consideration is paid by way of account pay check or account pay bank draft or by use of electronic clearing system through bank account or by any other electronic mode as may be prescribed, then we shall take stamp duty value on the date of agreement, not stamp duty value on the date of registration. In the illustration only we will extend the consideration extension. Consideration how much? 100 lakhs. What is the date of agreement? 1st August. 1st August 2019, how much is paid? 10 lakhs paid through account payee check. Then on the date of registration, 1st October, 90 lakhs is paid through RTGS. No problem. In this case, we shall take only stamp duty value on the date of agreement, not stamp duty value on the date of registration. Why? This is the date of agreement. On the date of agreement, part of the consideration is paid by way of account pay check. So we shall take what? Stamp duty value on the date of agreement, not stamp duty value on the date of registration. On or before the date of agreement, the whole or part of the consideration is paid by way of account pay check, etc. Then we shall take stamp duty value on the date of agreement. Case 2. 10 lakhs is in cash, 90 lakhs RTGS. Then on or before the date of agreement, okay, part of the consideration is paid, but is it by way of account pay check? No. Is it by way of account pay bank draft? No. Is it by way of electronic clearing system? No. Is it by way of any other electronic mode as may be prescribed? No. So we shall not take stamp duty value on the date of agreement. We shall only take stamp duty value on the date of registration. So one line summary of the entire discussion is, where the stamp duty value on the date of registration is different from stamp duty value on the date of agreement, we shall take only stamp duty value on the date of registration for comparison with the consideration to decide as to whether anything should be brought to tax under the head IFOS. But where on or before the date of agreement, if the whole or part of the consideration is paid by way of account pay check or account pay bank draft or electronic clearing system or through any other electronic mode as may be prescribed, okay, we can consider stamp duty value on the date of agreement, ignore the stamp duty value on the date of registration. So this you need to note. Next is (56) subsection 2 class 10 subclass C item A, where during the relevant previous year any person receives from any other person or persons specified movable property being a capital asset without consideration, then if the aggregate value of fair market value of all such specified movable properties received during the previous year without consideration is crossing 50,000, then the whole of the aggregate fair market value should be brought to tax in the hands of recipient under the head IFOS in the year of receipt. In the year of receipt. To consolidate, where any person receives during the relevant previous year from any other person or persons specified movable property being a capital asset without consideration, and the aggregate of fair market value of all such specified movable property received during the previous year is without consideration is crossing 50,000, then the whole of the aggregate fair market value should be brought to tax in the hands of the recipient under the head IFOS in the year of receipt. This is what given here in our material. Now, you should know, before we proceed further, the meaning of specified movable property. You should know the meaning of what? Specified movable property. It has been defined in explanation. The list is exhaustive, not illustrative. It means only these 8 items. What are they? Join me. Shares and securities, jewelry, bullion, drawings, paintings, sculptures, archaeological collections, work of art. What are they? Shares and securities, jewelry, bullion, drawings, paintings, sculptures, archaeological collections, work of art. So, these are all specified movable properties. It is not enough. Okay, if it is coming in this list, it should be a capital asset. Capital asset, specified movable property means capital asset being shares and securities, jewelry, bullion, drawings, paintings, sculptures, archaeological collections, work of art. This list is exhaustive. Anything not covered by this list, okay, doesn't invoke the provision. Fine. 56. Subsection 2, class 10, subclass C, item B, where any person receives during the previous year from any other person or persons specified movable property being capital asset, specified movable property being capital asset for a consideration. Consideration is paid, it is not gift. And the consideration is less than the fair market value, and the aggregate of fair market value of all such specified movable properties purchased for a consideration less than fair market value minus the aggregate of consideration. If this difference is more than 50,000, the difference should be taxed in the hands of the recipient under the head IFOS in the year of receipt. To consolidate, where any person receives during the relevant previous year from any other person or persons specified movable property being capital asset for a consideration less than fair market value, and the difference between aggregate of fair market value of all such specified movable properties acquired for a consideration less than fair market value and the aggregate of consideration paid for acquiring them, if this difference is more than 50,000, the difference should be brought to tax under the head IFOS in the year of receipt. So that you need to note. Here there are some relaxations from 56 to 10 CB. We'll stop here. We'll continue in the next class.